And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Welcome in Tasty CEO Tom Sosnoff, also founded Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah, as you should be, brother. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risks.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Stocks jiggle. Nothing big there, though. All eyes on gold. It's Tuesday, May 20th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan as we take you through the rest of this hour. Futures market closes at 5 p.m. Eastern Time. If you're watching on the platform, tastylive.com. Thanks for joining us. If you're on YouTube, tell us what you think of this market today, what you think of this price action where stocks coming a bit, not too much. Not great, not terrible. 0.5% loss for the S for NASDAQ. We're still holding above our 1-week moving averages. The Russell 2000 barely below water, down by 0.07%. We do see that we have a move higher in gold and silver, both up around 2% now. Gold up 1.96%, silver up 2.42%. Drawing my attention there first, speaking my book perhaps. But it's a good day for the metals as bonds remain pressured. We likewise see that the dollar mixed, but we'll have to talk about that RBA rate decision, Ilya, and then what to look forward to with tomorrow's UK inflation report as the currency markets are going to be in focus given the lack of U.S. data, earnings, et cetera, over the next few days. I suppose it's a good time as ever.
Some interesting stuff going on here that has U.S. knock-on implications.
Well, it's a good time as ever to remind people if you're trading currency, head over to the left side of your platform right now. You can scroll over to the watch list there and go to Forex, all Forex pairs. And if you click on any of the symbols, you're going to get this little pop-up to let you know that you can subscribe and get on the watch list, the wait list, excuse me, for SpotFX trading. That should be here soon. So make sure you join the wait list. You could see I've already signed up myself because, Ilya, I know that we want to be trading that here. All under one roof.
Honestly, my fingers are itching. I can't wait to have Spot in the same platform because, as you know, I am a absolutely unrepentant spot market participant. It's my first love as far as markets go. I trade it all the time. I would love to have it here. I can't.
Well, it's coming soon. Dylan, the S&P 500 breaks its 6-day winning streak. Alas, it wasn't a big pullback. The flow throughout the day wasn't terrible. Volume was fairly light. What do you make of this now? We barely crossed 1 million contracts traded. That's usually the benchmark I look forward to at the midway point of the day. Is today just a day of breathing, taking a breath, catching a sigh of relief that things aren't turning over?
I think it's self-evidently that. I mean, come on. I think that this is obviously anything is possible. I take no negative interpretation from the fact that you had a very small. I mean, you call this a down day. I'll call this an unchanged day. I mean, I realize net it's a down day, whatever. But my optimism is unwavering and unabashed.
Take a look at a intraday.
For the same reasons.
I mean, obviously, this is a pinprick in a rally that's been more aggressive, but when you look at the intraday, this starts to look a little bit more interesting. And I think 4 hour, 8 hour, you start to see this interesting things start to happen where you're under the previous swing high. So you kind of fail to break above that. Momentum is starting to give you negative divergence. I mean, we have MACD and stochastics here. I look at RSI. It's basically the same thing. So it's starting to look like maybe we're either going into some kind of a sideways drift, similar to what we saw at the beginning of May, where the thing was consolidating in a range until we got that gap higher with the China maybe deal, maybe not, whatever. But it does look like, at least for now, momentum is spent. And it'd be interesting to see, even just very near term, over the next day or two, where do you find it? Because there isn't data that really sort of speaks to the core story at face value until Friday, when you get the PMIs. So they'll start coming out Wednesday into Thursday. They'll be out on Thursday. Friday will be kind of the first day in their wake. So it'll be a while. And so looking at all of this now, it's interesting that the market chose a default that wasn't more gains today, because it didn't really have a reason not to. Maybe it's just exhausted. But if it doesn't want to rally without catalysts, then it's unclear to me that it has more juice to keep going. This was a week for it to pick a default. This is one day. It doesn't mean anything. But the default it chose today, in the absence of anything of substance, was weakness.
It feels.
I would disagree with that and say that the default that it chose today was to hold its current strong position.
In that it's one day, yes, I agree. But it had no reason not to keep going higher, no obvious reason,
Fair.
And it didn't. Right. So
it chose to. I agree with. I understand what you're saying.
But that's one day.
But counterpoint to that, we just got a downgrade. Right, the U.S. no longer has its full AAA rating, now completely stripped of any last vestige of it.
As though that means something.
Come on, you're going to bring this up? I think you just want to talk about the ratings agencies again.
Not quite.
That's just because we had an agreement yesterday.
No, but why? I think Tom was pointing this out too. Like, this was, if you were a bear looking at the close today for the market recovered into the close. It wasn't a limp into the close here. People would think we're trying to push this lower today. And, as those guys like to point out, a market that settles higher into the close is typically shorts getting out of their, day trading positions. Mm-hmm. Why couldn't it be looked at that way? That you just had all this negative news. We're 40 days into a 90-day pause that has no clear off-ramp. This talk of more tariffs, China's accused it, blah, blah, blah.
Why today? That's what ultimately.
Why today for anything?
Exactly. So the market didn't have anything new today. All of these things are, of course, things. I mean, here I am sitting in put verticals that are at this point about 30 days old and still have about 30 days of duration in them, because obviously the timing to this whole thing is very tricky, and I've termed myself out accordingly. So obviously there's been reasons to be suspect of all of this in my mind for a while, but what's curious to me is that this happens today. only in the sense that there was nothing in particular today to add into the mix. All of these things that we only have 40 days left, that all kinds of things might happen in that period. All of that was true yesterday and the day before and the day before for the most part. So why today? And again, it's not a big decline. It's one day. It means nothing. It's just interesting that it happens when there is nothing going on and the markets have a chance.
The tea leaves. It's like when there's nothing to, in the world of positive drift, when there's nothing to do, the default is to bid the stocks, to bid them higher.
I mean, if we're to your point yesterday, Chris, which I think is very, very important. Speculators in the latest COT report got more net short into the rally as of Tuesday last week, and by a good margin. So they were selling all the way into that rally. That's going to put a lot of pressure on people because they're on the wrong side of the market and they need to show performance in the second quarter. They had no reason not to chase today. It was wide open. Why didn't they? That's the only thing kind of, and then gold rallies and the dollar sells off and bonds don't hold the sell off. They anchor at that hammer at the start of the week. So it's kind of a curious mix. Does it mean anything yet? I don't think so. But it's something I'm watching very closely.
I mean, today was a nothing day. If the market was up by 0.5%, it's just grinding to the upside right now. Volatility staying low. You don't have much trading volume, if anything. That to me is the most glaring. What was today? 1.05 million contracts traded in ES. That is light. That is really light, Ilya. Yeah, that's where we want to be when futures power hour starts, and that's nowhere close to where we were.
No, it's very
even with this, slightly red day today. Granted, it's not a good day when you look at the sector performance. I think that's just a bridge worth crossing right now. Yeah. ES obviously down by 0.51% here after hours. Overall, biggest underperformers: home builders, energy, real estate, banks, but also consumer discretionary, technology, SMH. They're all red. And on the flip side, top performer: gold, GDX, GDXJ, retail. That's actually a nice surprise. But then staples, healthcare, utilities. So the green stuff in equities is the defensive aspect of the market. Yeah. The red stuff is the more growthy name of the market. That's not exactly the kind of breakdown you'd like to see today. And then again, this is kind of what you want to see here. Breadth is actually getting a little bit better. You could see that RSP, the equal-weighted S&P 500, QQEW, the equal-weighted NASDAQ, those are both down, but not down as much as the headline market cap-weighted indexes. So there's good and bad. You could paint a picture either way. I just don't know if we're looking at this week where, what was the most significant catalyst today? Home Depot earnings?
That's what I'm saying. It's weird.
Trump, going to meet on Capitol Hill with all the congressional Republicans holding out on the one big beautiful bill. What's the catalyst today? There wasn't really anything one way or the other. The news flow wasn't necessarily supportive of stocks. I wouldn't say it was harmful. That's why I was talking about.
No, it didn't seem harmful at all. I mean, I guess the Home Depot thing was a little bit interesting because they said they were going to keep eating the tariff margins, whereas Walmart has said that they're going to pass it on. And I guess we're going to get Lowe's and Target tomorrow, so we'll see where they're at with it. But there was really nothing here that seemed to jump out and say, yeah, don't keep running this up. Everything's okay. Again, I don't think this means anything yet. But let's put it this way, if what you wanted to tell you that there is some sort of an untoward thing that's about to happen in the S&P, and your line in the sand was, let's say, a break back below 5,900 into the upper 58s, kind of where that sort of congestion area of former support, resistance, now support again is, call it like 58, 36, 58, 40, all the way up to, let's say 58, 80. All of that, if your line in the sand is we break back below that and that's the start of something different, that's the rally failing, you're closer today. That a little bit. And the momentum is telling you that as you're setting higher highs, the capacity to close higher is fading. So fading momentum indicators are telling you, okay, you're a little bit closer to some kind of something. And maybe it's just digestion, like the beginning of May. We can see there at the beginning of May, after the initial surge, there's, about 5 days there of consolidation. It could be nothing more than another stair step. But something seems to be occurring in the price action. Very kind of preliminarily.
Dylan, I saw these comments earlier today, and I ran them by Tom. I ran them by Tony. I ran them by Jamal as well, so I'm curious as to your take. JP Morgan CEO Jamie Dimon was saying that people are too complacent right now. The market was down 10%, back up 10%. Effective tariff rates are still much higher than they once were, just at the start of the year, a point that Ilya's made. Sosnoff made the point of saying that this is Jamie Dimon's shtick, that Jamie Dimon likes to pop his head out above water, and when he talks about financial markets, he's usually very bearish, more cautious, glass half full kind of guy. And in thinking about that, I did point out in our conversation this morning, when you think about Jamie Dimon's warnings about a hurricane coming to the U.S. economy, those never really materialized, and then he kind of backed off that line of vocabulary for a little while there once it became clear the recession wasn't going to come to pass. So at risk of besmirching the nation's greatest banker, do you think that Jamie Dimon is someone credible to be listened to when he says that the market's too complacent?
First of all, I would say he's more credible than most at the end of the day. Doesn't mean he's not wrong half the time or more, like most people. But I don't know that Jamie Dimon is to be dismissed either. I mean, just because of but I do agree that it tends to be, at least in his public comments. The thing is, if you're the CEO of JP Morgan and you've built JP Morgan into the financial institution that it is, you own an institution, or you manage an institution. You don't own it, but you manage an institution that really, from the bottom through the executive offices, is designed to be bullish, right? It's an asset accumulating, risk managing, risk sort of underwriting business. And so in some ways it's sort of a nice counterbalance to have the privilege of being the CEO of a risk-taking, optimistic, an institution that's long risk by its merits of its existence in many ways, although really they're probably more long fees than they are risk, but they're long fees charged to risk-seeking environments. That to take a more cautious point of view is probably just better for business. Because part of what you're selling is the sort of ambiance of seriousness and prudence, and whether it's correct or not, publicly being cautious about financial assets, especially when you're not a trader, you're not a prognosticator, you're a CEO, is it's a better position as a leader, whether it's right or wrong. You're much better to say, oh, the market's complacent, or I'm worried about this, or I'm worried about that, than you are to come out and be, nakedly bullish all the time. But I do think that it is basically irrelevant. In other words, I don't believe that it has much predictive value. But I don't think that that's a diss on Jamie Dimon. I think that that is a function of the human relationship with speculating about the future of financial asset values.
I mean, that's the two-step, right? We call it, or at least I call it, the old Jack Welch: beat guide lower, beat guide lower, beat guide lower, right? Constantly lower the bar for yourself. That way it's easier to clear in the future. But also with Diamond and people in his position, right? Like if he gets too far out over his skis and they open up their books and they underwrite too many loans, what happens to the bank? Right? They can't really. He's not in a risk-seeking position. He is a much more risk-averse individual. But he's still not someone that's going to be ignored. If the head of the country's largest bank says that he thinks that people are being too complacent and bad things around the corner, a lot of people are going to end up listening to that. Ilya, could I pose a different way of thinking about this, though?
Sure.
I recall, because I refuse to let my attention span be whittled down by dumb TikTok videos and Vines and all the other things that kids use these days. I distinctly recall Jamie Dimon being one of the people who, in coming across as bearish and, dare I say, a Dr. Doomsayer at the start of April, that was one of the reasons why the Trump administration backed off, because he was on with Maria Bartiromo on Fox News. Dare I say that a bearish, fearful Jamie Dimon is one of the best things that we could hope for the stock market? Because Jamie Dimon seems to be one of the people that Donald Trump listens to when he sticks his head in the media.
Just a couple of guys from Queens, you know what I'm saying? Donald Trump likes a guy from Queens.
I mean, I think that's a nice little factoid that bears repeating because it's interesting. I think if your trading strategy is predicated upon trying to read the tea leaves of who the president is going to listen to on a given day, you need many more tools. You need many more tools in your toolkit to make sure that your understanding of where the president's mind is not faulty that day. Because
it's a dangerous game to play, by the way.
It's a dangerous game to play.
Trump pretending that you understand what anyone thinks and you're in someone's head, like trying to play the game of where someone's head's at any given time. I'll just say it's a stupid game to play. You're not going to guess right.
The only thing you can do is try to play the game of where the aggregate market's head is, because you do get the price action. So you get to look at the price action and actually see where things are heading in real time. But trying to be a Trump whisperer through a secondary source seems to be a dangerous kind of a thing to hang a strategy on. It's interesting. I think Jamie Dimon can be interpreted almost as a central banker, in the sense that he sits atop a giant financial institution with a really long arc, and people go, oh, well, you forecasted a recession and the recession didn't come. And the response from him, much as a central banker, would be, well, yeah, it's been a few months relative to when I said this, even if it was 6 or 9. Like, my vantage point is a decade, 5 years, 3 years at the shortest. I'm not looking at this from the perspective of what's going to happen in the next quarter. And to Dylan's point, it's probably helpful to talk your book if you see something that looks untoward on a 3-year time horizon. It's commercially advantageous to say those things out loud in a quarterly earnings format, because then as you keep beating, you look like either you're managing the thing well or you're persevering despite. But that doesn't mean that he's wrong. His vantage point is different. It's longer.
The incentive structure.
Incentives are very specific.
And the incentives are to share those long-term concerns out loud. Like, they're probably genuine concerns. A lot of them make a ton of sense if you look at what the markets were initially freaked out about in early April. Like, when Liberation Day happened, if you looked at sort of the things the markets thought would be the problem were this to stand, they were the things that he's talking about. So it's not like he's out of school on what the concerns are. It's just he thinks nothing is fixed by and large. I tend to agree. The question is, what's your time horizon?
Right. So one of the reasons why I bring up what Diamond says, if only to provide to rebound back to how I view the markets, Ilya, and I know you view things in a very similar way. You kind of want to pay attention to what the policymakers are looking at. Yeah. Because if the policymakers are telling you, I find XYZ important, not ABC, don't waste your time with ABC.
Absolutely.
And so Raphael Bostic, the Atlanta Fed president, yesterday noted, and he's been someone who's been a little bit more cautious in his commentary, and he just came out again this afternoon saying he doesn't think it's appropriate to cut rates anytime soon, noting on a side here, or rather sidebar, no cuts scheduled for June or July according to Fed Funds futures or the SOFR 3-month contracts right now. Atlanta Fed President Raphael Bostic yesterday noted that because the data right now is so muddled, thanks to all of the noise, tariffs on, tariffs off, tariff rates up, tariff rates down, you can't really get a good read on where the economy is, at least in the short term, because of how noisy the figures are. So instead, he's paying more attention to the corporates in his district. He's listening to what businesses are saying, whether or not they're hiring, whether or not they're expanding CapEx plans, right? And so when Jamie Dimon, the head of the world's, but also the country's largest bank, it piques my interest because that seems to be the kind of person that a Raphael Bostic would be listening to, right?
Certainly.
And so there's reason for paying attention to that. But the bigger point from my view is, I think the best thing for the stock market, paradoxically, I want all the business leaders screaming, Dylan.
Well, and the PMIs kind of tell you that. I mean, this is sort of the interesting thing about the PMIs, which the latest updates do on Thursday. This whole thing, this whole growth scare that we had at the beginning of the year, the whole thing was about business confidence collapsing. It's not like Jamie Dimon is on an island here. The PMIs have been falling through the floor. This is not
raising the cost of everything with tariffs is a natural slowing mechanism.
Well, and this is what makes actually the conversation that there is to be had about global inflation such an interesting conversation relative to what someone like a Bostic is saying. When the Bank of England cut rates earlier this month, the market reasoned they would be less inclined to keep going. Though they cut, the outlook actually shifted to less dovish. Canadian CPI data came out today dramatically lower at the headline because they took away a carbon tax. It expired at the beginning of April, but when you look at core inflation, surged, highest in 13 months. You look at Eurozone inflation data, and again, there's a big thing from energy costs going down, keeping it steady. But you look at core, 3-month high. You're about to get UK CPI data, expected to be significantly higher than expected. Meanwhile, none of the growth indicators have become any better. You still have standstill in the US and China and the Eurozone. So if ever you wanted to become on to go on stagflation watch, the inflation part of it is starting to come together, and the stag part of it is at the very least in the survey data, and all of it, because the global PMI numbers for April were a 17-month low.
Yeah, Jamie Dimon spoke of stagflation today. He says it's basically recession with inflation, which I suppose that's the great way to put it.
It's starting to happen a little bit here. And we already saw that the U.S. numbers were kind of a mirage. The CPI was normal, but then the PPI told you why it was normal. Because those pissed off businesses in the PMI, they're eating the costs.
Dylan, let's switch our attention here to First Buddy Capital, Elon Musk, today, out in the headlines for a variety of reasons, says that Tesla has a plan for robotaxis to be on roads in Austin, Texas next month. Perhaps they're finally here. He likewise said that he's scaling back his political donations, and he's recommitting himself to Tesla for the next 5 years, assuming his pay package is approved. What do you find most interesting about this Tesla story now? The volatility really has come off the board here. I know that you were optimistic several weeks ago. It's now up at 343. Is this good news that we're going to get Musk in the driver's seat at Tesla for the next 5 years?
Absolutely.
Yeah.
Absolutely. Yeah. I mean, there is nothing that he has done other than turn his attention away from Tesla to make anybody reasonably suggest that his leadership at Tesla is not a good thing. Whatever your opinion may be of his political activities the last few years, Elon Musk being at Tesla and driving the problem-solving process for whatever their bigger challenges are, and driving market development globally is a good thing for Tesla. And I think the stock goes. I like the stock, as you know. I mean, I've liked it for a little while.
It's up 50% from the lows that we saw at the start of April. Not too shabby.
And moved through that abominable earnings report with indifference.
Well, they were firebombing the dealerships, Dylan. I think we all knew that the
numbers weren't going to be so great.
No, right? Like, talk about praised in.
I mean, I think Musk is one of those things where the more he sticks to talking about electric cars and space travel and tunnels and whatever else he's got going, and engineering adjacent activities at his companies, I think the better off he's going to be in terms of the value of his publicly traded companies.
Yeah, I saw.
As a Tesla investor, I think you're right. You want more Elon Musk, not less.
I saw a report today about brand perception based on like trust and the community and all these squishy factors, I'll call them. They're very subjective, right? It's all about consumer perception towards brands. And a few years ago, Tesla was ranked like the 8th most positively viewed brand in America out of of this list of 100, and it dropped down to 96th in this list of 100 names as of this year for the new survey.
Which is entirely obviously the politics, but I do. That's what I'm saying. Like, I'm not that anybody. One, I don't think he cares, and two, I don't think he listens to anybody. But if he did care, or if he did listen to anybody, the rational advice to him would be, stay out of politics and focus on your dreams of space travel and global EVs and solar power and all of his original sort of dreams,
Yeah, get back to making us a Karstev one civilization. Get away from meddling in Social Security.
What are you doing with those? You're not helping yourself or anybody else or your companies.
Yeah, we're not going interplanetary if you bankrupt Social Security, Elon. Come on. Leave Granny alone. Send us to Mars.
But I'm just saying, from a trading perspective, it's better to own Tesla when Musk is involved than when he's not. I think the chart shows that.
It's so, Ilya, that's such a good point here. And, I know that we've strayed over the last several months into being a little bit more political than I think any of us would like. And I certainly feel that I have to chagrin sometimes. But Doge's peak influence is like February, March, and that's when Tesla is at its lows. Mm-hmm. Haven't heard much about Doge these days coming out of DC with a $4.2 trillion budget. Forgot to add on another $2 trillion in interest expenses, so $6.2 trillion in new debt, right? I mean, Doge didn't work, didn't make a difference at all in terms of saving any money on the deficit of the debts. Big picture. And the second Elon Musk
look like it.
The second Elon Musk kicks Doge to the curb, the stock price goes up 50%. I mean, I don't know if this is back to 500, but if he's still going to be someone in President Trump's orbit and not in front, let's just entertain a scenario. Is there a scenario in which the S&P 500 is back at all-time highs where Tesla is not having a conversation where it's up in the 400s again? I think those two things are quite linked. This is the high beta, obviously, but I think those two things are quite linked. If stocks have a short-term path higher, then Tesla probably does too.
Well, if stocks do, then Tesla does too, because it looks like the idiosyncratic factors that were holding it down are not getting worse, and if anything, are getting better. Like, obviously,
I mean, my bigger question for Tesla is, I mean, at some point, and I feel like we're kind of coming up on that point, every other car maker is going to have a competitive EV, and that Tesla's sort of unique position has a half-life that's going to collapse pretty quick.
Globally. Well, they just got rid of the EV credit.
One interesting thing here, actually. So Elon has
Japanese. What is it?
So Elon has said a gazillion times that his biggest competition is China. Problem is that competition is imploding. And it's imploding because they've built a ridiculous amount of cars. They don't have any markets to dump them on because everybody has realized that they have incredible oversupply, that their domestic anemic consumption could never begin to hope to absorb. And so you now have this huge supply of these cars. There's nothing to do with them. And because there is, I saw this today and it made me chuckle, because the president has given China a carve out on electronics in the tariffs, they have actually started to tear the cars up, pull the batteries and the reusable components out so that they could put them into electronics, which can in fact be exported to China's largest export market, the US, because of this waiver. It's a very curious story. And so it's quite possible that you get a leg up for Tesla here, provided, by the way, that EV demand holds up, because it hasn't. It's been kind of falling apart. But
that's, by the way, I have to interject there. That's so shocking, because I was thinking the same thing too. Like, oh, I wonder how the electric cars ETF is looking these days. And iDrive is basically sitting, right at the top side of a 6-month range. A lot of this is Tesla, but a lot of this are names that are, even NVIDIA is in this basket, this ETF. But nevertheless, like approaching the top side of a recent range that maybe we're about to turn the corner. Maybe a new narrative is about to emerge.
If demand holds up, because obviously this is the picture here that you're seeing is standstill since early 2024. So this is not the S&P, right? Which clearly tells you what's going on with these names, right? Demand in this sector has been weak. And so you look at this and you go, okay, so if demand holds up, maybe Tesla has a bigger bite at market share with China kind of hemmed in. Everybody's at this point passed anti-dumping rules against them. Europe, even Brazil, hilariously, Russia is protecting themselves from China dumping cars on its markets. So we're getting to a place here where if demand holds up, then Tesla might have a bigger share of this market, which could be good. But that's if demand holds up.
Ilya, cars right now rebounding across the board for what it's worth. Ford is trading higher than it was on Liberation Day. It's actually at its highest level since the start of December. Mm-hmm. Same thing can be said for GM, which has basically taken back all the losses from Liberation Day and going into the pre-Liberation Day levels when they had their earnings. So the car companies seem to be doing fine. They're announcing that they're passing on cost to consumers, which is just lovely.
This is another, by the way, interesting thing. So much of this supply chain is running through Mexico. And although the conversation between President Sheinbaum and President Trump has been generally fairly cordial and friendly, they're going through a interesting judicial reform in Mexico. And you can kind of look at it first as something that may be helpful, perhaps, for kind of callous reasons, in the sense that all judges in Mexico now will be elected. They're the only country, really, of the majors that will have a fully elected legislature, which basically means everything is
a fully elected judiciary.
Judiciary, yes, sorry. So this obviously suborns the judiciary to politics, something we try to avoid and most countries try to avoid. That we elect any judges in the U.S., in fact, is unusual. Most countries, no judges are elected because you try to keep them away from the political cycle. You want them to rule impartially. And so,
for what it's worth, I mean, like having, being involved in local politics, the judges are kept separate, everything politically, for the sake of no
but
politics
there are
in the judicial
municipal
system.
Judge elections.
Oh, there's one coming up in my town in a few months.
Right. And that's unusual for developed countries generally. In Mexico, it'll be very extreme.
I would say those countries aren't so developed, Ilya, but could keep going.
In Mexico, which is the important bit here, all judges up to the Supreme Court will now be elected. All of the ones that were currently sitting have to go through an election. A bunch of them have dropped out and basically said, I'm not doing this circus, which will open up a lot of space. So the rule of law in Mexico is about to become fuzzy and subject to who can pay for a political campaign. And that's obviously, to some extent, the cartels.
Are you sure Mexico's not going to be the 51st state? That sounds a lot like America.
And so we're getting to a place where if you want to do business in Mexico and you want to get the rules moved in your favor, now that could be easier for would-be American businesses. And I suppose that's one thing that's interesting. But also, it might be a deterrent to investment because now there is no legal recourse you could count on as readily if, let's say, a cartel decides that your factory is now theirs.
Oh, Dylan, that just reminded me. That's now the next great American foreign policy reform issue. Get all these countries to have judges that can be elected, so that way American donors can pay off the judges to let American corporations into those markets.
Mm-hmm.
That's the lobbying effort.
You don't have to just go down some negative, catastrophic fantasy every time somebody has an election.
No, we could figure out how to open up markets and get the PE ratios.
Oligarchs will pay the judges to.
Well, so this is the whole thing, right? Is on the one hand, the oligarchs will want more economic growth and more
puppies don't vote, Dylan.
More commerce, right? So, in terms of averting the trade war, this might be a good thing. So I suppose this could be good for automakers on some level. It's probably not good for Mexico in terms of attracting investment capital.
Ilya, if the start of the year we said Trump's going to be doing these arbitrary, capricious Calvin ball tariffs that are income taxes, manufacturing, whatever we want to say they're there for, Mexico is front and center to all that.
Yes.
EWW is up 29% year to date right now. Square the circle here. If there's a trade war going on, how come Mexican stocks, which derive their value from the future cash flows discounted at net present value to net present value, why are those cash flows now worth 29.28% more than they were at the start of 2025?
Look at where the bottom is.
Start of 2025.
What was your answer?
I'm saying, look at where the bottom is. It's not rocket science. The surge that you see, I mean, that's just consolidation.
You're saying that it's the pause on the end of the
It's the pause on the reciprocal tariffs. Look at where the spike is that starts the rally. like any other global stock index. It's not different. Go to the beginning of April. Yep, that's it. We know what that candle is across every stock market everywhere. It's not different. If anything, it's much more restrained than the rallies you've had in Canada, much more restrained than the rallies you've had in Europe, much more restrained than the rally that you've had in the U.S., of course.
Canada's up 9.65%.
Canada's at a record high.
FEZ is up 24%.
Yeah.
This isn't, the EWW is not lagging far behind. China's up 19.12. I'm just saying,
one?
FXI, not A-share.
Right.
A-share is up 2%. Right. A-share is up 2%. But I'm saying, like, if this is what I'm trying to, like, circle this back to the diamond thing now. If we're clearly not the only complacent ones, right? You know, people are being complacent about the market. Everyone is complacent everywhere, right? European stocks have been bid. Canadian and Mexican stocks have been bid back up.
Yeah, but European stocks are at their highs. Mexican stocks are nowhere near their highs.
No, automakers, though, have been bid back up, right? Clearing the April 2nd levels.
I mean, no one thinks these tariffs are happening and are going to have a meaningful...
That's right. It is an unclenching, a preliminarily... Let me back up. If the market wasn't afraid of tariffs in November and was taught otherwise at the beginning of the year, they are now not afraid of them again. Have we learned our lesson? You don't want to be a Trump whisperer. And the markets were a Trump whisperer in November and December. And they learned otherwise. They're being a Trump whisperer again. They're assuming in a very Panglossian fashion that everything will ultimately work out. They were already shown that everything isn't necessarily just all going to work out. There was a fake crisis that was completely self-created. And then when it was taken away, they got all kinds of happy. That crisis was completely manufactured. It didn't have to happen. There was no economic reality that demanded it. And now everybody's so happy because, oh, good, the scary thing was put back in the box. No, it wasn't.
No, but the thing was temporarily kicked down the road. Yeah. Because the people who operate in the markets, capital is cowardly.
That it is.
Right.
Capital is what?
Capital is cowardly. Capital is not. It's not brave.
Sure.
Right.
Sure.
Capital flees at the first sign of, what are those waves coming up? Oh, okay. Like, okay, just relax. It's a little bit of wind. No, people panic over nothing sometimes. And so the fact that the market was able to get to a point where it could have the White House tap out, I think is self-reassuring.
Sure.
Because there are points there in February and March where it's like, I don't care what the stock market thinks. And all of us are looking around going, you don't care what we think? Oh, God, he doesn't care what we think. Why are we holding the bag still? But if he's back in a mindset where, he cares what we think, and we got him to tap out, the collective we, the market, the bond market, the stock market, gold, then why wouldn't we think that we can get him to tap out again? I mean, it's going to be a game of greater escalation, right? Dylan, if he comes out and puts the tariffs back on the board that he did on April 2nd, does the market go back down to 4,900? And okay, we'll show him again and not take it too seriously. I mean, it's going to have to be a game of greater and greater and greater escalation now to get the market to break, because his bluff has been called already once. Is that fair?
It's fair, but I still think that embedded in your question is some degree of the impossible, which is sort of Trump whispery, other than the fact that Trump is impossible to predict and easy to predict all at the same time. And the one thing that's the most predictable about him is a huge focus on rhetoric with inconsistent follow through, I guess we'll call it. And I just think that I just don't see how you get to the July, August, this whole situation, and don't end up with the majority deals with majority of the relevant, and then they'll pick a few countries and be like, look, so-and-so didn't make a deal, and so we're going to screw them, and then that's a way to kind of look to save face, I guess. But ultimately, you wouldn't, Mexico's chart wouldn't look like that. The car charts wouldn't look the way that they look.
What
tech stocks wouldn't look the way that they look. Jamie Dimon wouldn't be out crying complacency.
It's true.
But for and I guess your point, Chris, is, well, who's to say Trump's not going to come out on July 8th or July 4th or whatever it is, and not going to just for the sadistic pleasure of it, just jam everybody right in the face with a hot poker.
He could, but again, let's say he doesn't. Let's say everything goes exactly as it is flowing right now. Tariffs have gone up 5-fold. Let's say all of the reprieves, all these 90-day things, let's say that all of them are made permanent. Tariffs have gone up 5-fold. We're back to tariff levels unseen, basically going back to the 60s, maybe earlier. So
you're saying at the deal, at the post,
the 10% minimum,
the 10%,
right?
Yeah.
Let's say we get a deal with Japan next. That looks like it might be the next one, kind of near the top.
Japan probably needs a deal given what's going on in their bond market right now.
Let's say they lock in at 10%, like the UK did. China is at a minimum of 30, but let's say they work it back down to 10 because there's some sort of performative, no, we'll really buy the extra soybeans this time kind of a deal. Fine. China wants a deal. The U.S. wants a deal. Everybody wants to look like they did something. Inflation is already on the rise. We're seeing it. We just talked about this. It's starting to show up. Central banks aren't going to be ready to act. Growth is at a 17-month low. We're not in a happy setup here. So markets are, of course, cheering that the person with his finger on the implode everything button decided to put it back in the drawer. That's great. But that doesn't mean we're in a good spot. And so for me, the question is, when does sentiment begin to focus there rather than this pointless back and forth?
Well, I said when you started to speak here, and I apologize for interrupting you, like there's 2 cycles until then, Dylan. Like July, what point in time do we cross this bridge? And you say, could he do something after July 4th? If we think about 45 and 21 now, today was day 40. May 25th is 45 days is the exact halfway mark from when the pause was announced, okay? So today's May 20th. We're 5 days before May 25th. We're at 40 days since the pause. So 45 in, 21 out, you're able to have 2 more cycles of trading, if you will, in the typical Tasty way, prior to the tariff pause window ending. And if it doesn't end and it's kicked further down the road, why would you think that could be the case? Here's something very simple. Ilya, our old friend Math, Dylan, you may know him. The math of this is that if the tariffs are not extended past the July window, there will be a month or longer where there are lower tariff rates on China than on other countries, which would then incentivize manufacturers to build more stuff in China and less in places that are not China, which would be, I think, an affront to the administration's stated goals of kind of like a soft decoupling where they can make the tchotchkes and the shoes and the T-shirts, and we do all the high-level advanced manufacturing stuff here or among our friends, right? But like the administration doesn't want to have that. That would just be egg on the face. So one would presume there's going to be a push out at least to August, perhaps into September, maybe longer. I just think that we have 2 cycles to deal with. I think that we have to worry about the earnings, NVIDIA earnings coming up next week, far more important than any tariff talk, unless Trump obviously pulls a rabbit out of the hat, which he is far more than capable of doing at any given moment.
Yes.
Ilya, we touched on this at the start of the show, though, and we haven't had a chance to do it here. I know Tom was suggesting that if a central bank comes out and warns of short covering, makes you want to do the opposite. And in fairness, when the European Central Bank says that it thinks a market or an asset is going to go in a certain direction, I look at our European friends and think they're probably wrong. So I am partial to fading this, but gold today has this really nice day where it is technically a bullish engulfing bar. We moved below yesterday's low, closed above yesterday's high. We can go back to that 4-hour chart. I see an inverse head and shoulders pattern here coming out of the low.
I agree with you.
How are you feeling about gold right now? Because it feels like the downgrade. You're still long and you're still looking long for the rest of this week.
Okay. I got long today. I think the breakout that we were waiting for arrived. I think we were looking for this thing to pick a direction. It seemed to have picked one. So I was looking to get long via just buying calls, but the vol is too high, frankly, and so the risk reward math on verticals didn't make any sense. And so instead, I sold puts and got long that way here in GLD to keep things small and and not get overextended. I was able to get almost a 1-to-1 risk reward on it, which is very good when you're selling puts. You don't even. I'm upside down by maybe a couple dollars. So we're looking at, I think, a pretty interesting setup here. We could find our way to the range top, I think, without that much of a lift.
Range top would be nice. Dylan, I know you're not a gold guy, but silver today, your friend Silver, did make an impressive move, starting to break out of the downtrend from the March, April, May swing highs that we see here. To that extent, silver prices are the leaders today, up 2.32%. It's a big day for commodities. Natural gas up another 9.83% as well. Dylan, take us out, though. I'm sure you have some interesting thoughts on some of the political news not surrounding Donald Trump. Any strong thoughts on the timing of this Biden diagnosis?
I mean, you're going to leave. I think overtime is out of time. As much as I would like to.
Too bad. All right, we'll be back tomorrow.
Sad to say, I believe overtime is out of time.
That's our show for Tuesday, May 20th. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak and Dylan Radigan, I'm Chris Vecchio. Good luck trading. Stick around, though. Ilya Spivak's coming back with Macro Money. He's also going to be back for the Price of Truth with Victor Jones later tonight. See you there.
Indeed. See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
All right, Mike, we have earnings coming up next week in a time of high volatility and a lot of uncertainty. What advice would you give to traders in terms of attacking earnings in a time like this?
Great question. I think every so often we have this pocket of time where everyone is talking about the same thing. Or when Bitcoin and crypto came out, we had Radio Shack talking about it. We had a coffee roasting company talking about it. Now I think you're going to hear a lot of tariff implications. So there's going to be a lot more heightened implied volatility in that weekly cycle where earnings are. Just doing your due diligence, have an understanding of what might impact the company you're trying to trade and how potential tariffs might impact that.
And what would you say your earnings checklist is? What criteria do you look for in a company if you're going to try to make a play on earnings?
You have to be really small. Even when you have a super strong assumption, you can be really wrong with earnings. The options market's closed when the earnings come out. You can't adjust unless you're hedging with stock, which I would say maybe size down more than you normally would. Stay defined risk. Just because a company reports good earnings numbers doesn't mean the stock is going to go up. Just be prepared for a lot of uncertainty.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
I had a pool like 30 years ago.
Okay, what do you want, a medal?
You did? Huh?
Yeah, he did. No, indoor pool. It was quite nice.
Yeah.
You had an indoor pool?
1988.
Yeah.
I built it because it was a big warehouse. So we built an indoor lap pool, and it was 40.
The dog loved it.
Do you have an indoor basketball court too?
Yeah.
Wow.
But that was
and a racquetball basketball.
Yeah, but then, remember, it was a big warehouse, and it was like.
No, I don't remember. I was not even alive.
Wait, listen for just a second. I want to go to Buc-ee's. I've never been to a Buc-ee's. I have watched a lot of Buc-ee's TikTok videos over the years, and I have watched everybody do food reviews of Buc-ee's, and I feel like I've never had the opportunity to go into a Buc-ee's because I've never been around one.
Sad enough, it's a humongous gas station. It's like the size of a city, and it's super clean. And they've got everything you want, from new underwear to food to eat. 24 hours a day, 7 days a week. It's beautiful. But don't sleep on the bathroom, Sadnov. Even if you don't have to go into the bathrooms. They are amazing. They are so freaking clean, and you can watch the attendant go in after you're done. Like every time somebody's done, bathroom attendant goes in there. It's the most amazing thing I've ever seen in my entire life. It's the best run bathroom in the world. When you're on the road, Sadnov, and you're looking to relieve yourself.
I have so much to say. I have so much to talk about this.
Please don't.
Here, he said he was listening to a podcast.
Yeah.
And he said somebody on the podcast was talking about, they knew us, and they were talking about it.
Yeah.
And the person said, I don't know who the person was, they were the ones that gave you the beret. And I said, that's BS. I said, I think, but I got to ask Tom, I think it was a marketing company that sent it. I know the Goldfish was. Where did you get the beret the first time?
Where'd I get it?
Oh my God.
Yeah.
I'm telling you, I wish I was in the mafia and he was the only one that saw like what went on. He's amazing. He's great. You'd be a great witness on this.
Great witness.
I got it. I just had it made myself.
No, you did not.
Yes, I did.
Go ahead. Where'd you have it made?
I'll tell you exactly what happened.
Go ahead.
So sometimes, like my hair would get in my eyes, I'd like to wear glasses.
Like if the windows were open.
You always wore glasses.
Always. But
always.
if the windows just
Summer,
so people.
I'm explaining. Will you just let me explain?
Go ahead.
So we were coming up with different ideas over what we were going to give away. So we bought things like we got some barbecue sauce that was branded. We gave away stuff each month.
Yeah.
So 1 month I decided to make berets. We made aprons and sandals.
Yes, true. Facts. I still have my apron. I have my apron.
Okay. We made all.
I don't think they weren't sandals.
You made sandals?
They were flip-flops. They were flip-flops, not sandals.
And so
part is true.
one of the first things we got was a beret, but I didn't order them because I was like, these are too hard to like stretch.
They didn't fit your head. Be honest. They did not fit your head.
Can we explain how we originally shaped them? We got a basketball. We stretched them over a basketball.
How we originally? That's how we do it to this day. Are you kidding me? We're like an Italian.
And not a WNBA size. It was an NBA, not WNBA.
So that's how I did it.
Get the full scoop by checking out the archives at tastylive.com.
The markets finally take a little bit of a breather on what is a very slow day for Wall Street. There's perhaps something to be said for a lull in U.S. economic data and screaming tariff headlines to motivate volatility. But there's something that seems to be bubbling under the surface in global economic data that is perhaps shaping up to be a greater spook for financial markets as we look ahead. We're seeing some interesting data come out here over the course of this week, and some more interesting data that's coming up in the coming days, and indeed even just in the next 24 hours, that start to warn that after a protracted slide in global inflation rates, after global central banks, led of course by the Fed in 2022, went on a tear raising interest rates to put post-COVID inflation back into a box, that something seems to be perking up again. And it's happening at the worst possible time for economic growth. So we started this week with Eurozone inflation data, which at the surface seemed like it gave us a second consecutive month of 2.2% inflation. Not immediately something you might start to get concerned about looking at it, but it is the first time in some months that inflation didn't fall. So perhaps that's interesting. The first time in 3 months, as a matter of fact, that it held steady. But it isn't so much this that grabs the attention. It is that looked at through the lens of core CPI, where you strip out the influence of food and energy because they're set on global markets and generally relatively volatile, so the central bank doesn't really have much agency here. There's been a jump to 2.7%. A significant increase, needless to say, from the 2.4% in March, and back basically to the starting line at the end of last year. When you look at what happened here, and you look at the internals, what you see is there was a significant increase in food prices. There was a significant decline in energy prices. And in fact, this decline was larger than this increase. So when you looked at the headline, you got to 2.2% because this move here was enough to offset what happened here and here. But when you take this away and you take this away, what you're left with is this increase in service sector in inflation. As a matter of fact, of the 2.2%, 1.8 percentage points was services, and most of that was right here in hospitality, which may be just the knock-on effects of higher food prices that appear not just at the immediate level, but in terms of the price of services that use the materials. And so you get a sense that maybe what's going on here is some sort of a knock-on effect that then shows up. But what you end up with ultimately is inflation that's going in the wrong direction. Then earlier today, you get Canadian inflation data, and again, at the headline, you get a dramatic decline. In fact, the lowest since September of last year. It's a little bit warmer than expected. The expectation was 1.6, which tells you that the market was completely ready for a big drop in headline inflation, and that's, of course, because of a huge decline in the cost of energy. Again, this time amplified to the nth degree by the scrapping of a consumer carbon tax as of April 1st in Canada. So these numbers were skewed by that. But again, you look at the core, and inflation is rising. It's even more dramatic if you look at the core version that the Bank of Canada likes to use. This one, as is traditionally the case with core inflation, strips out energy and food, and in Canada's case also mortgage interest payments and a few other things. But when you look at this trimmed mean version of core, where instead of cutting away specific sectors, you just cut away the extreme spikes up or down, no matter what sector they're in, to try to get at the central tendency in prices. And what you end up with is the highest inflation in 13 months at 3.1%. And the trend, of course, isn't particularly helpful. It's no surprise then that when this data comes out, despite the huge downswing at the headline, again, we just saw it right here, Canadian interest rates go up when the data comes out, and you can see it in the Canadian dollar, which, with the release of the data, spikes higher, and after some digestion, ultimately resolves its way with some marginal gains on the day. But here's where that data comes out. The market clearly is looking at the higher core readings and not the very widely expected distortion at the top. And there's the numbers we've just seen out of the US. Now, the market, of course, got very happy with the idea that this was generally a normal CPI report in April. Most of the inflation showing up in services as before, but perhaps most importantly, there is no great surge in goods inflation, which you might have expected was a risk with all of the tariffs that we've seen flying back and forth. Food is ultimately about the same contribution as it was in the prior month. So is energy. No big changes there. This, though, taken to be an encouraging sign that the tariff war isn't punishing consumers. But then, of course, we got the PPI data. And when you look at what happened there, it's this shock month-on-month decline. And when you look at where that month-on-month decline came, we can clearly see that, first of all, when you get down into the core, you still get a decline. So it's not food and it's not energy. It's not some sort of idiosyncratic factors like that. And when you look at goods inflation, again, wholesale, it did in fact rise, and it rose by the most month on month in, give or take, 2 years, a little bit more. So the goods inflation is there. What is masking it is this dramatic decline in services inflation. And what you find there is a 1.6% squeeze, which is very sharp for a single month, on trade services costs. That the margins there got squeezed by almost over 1.5%, let's say. Let's not round all the way to 2. Over 1.5%, which is a very, very significant change for a single month. And what that's telling you is that businesses are insulating consumers from rising tariff costs. They are essentially saying, yes, the tariffs are creating inflation. It's just we as businesses are going to, for now, bet that this is not going to be a lasting thing, and that we don't want to lose market share by raising prices on consumers. So we're going to eat this difference for now. Now, we just had corporate earnings reports from, say, Walmart and Home Depot. Walmart said they will pass on the extra cost of tariffs. Home Depot said that it's going to keep eating it for now. We're going to get earnings from Target and Lowe's coming up this week. We'll see what they say about this. But clearly, the macro level insight here is that this is something of a mirage. It's not showing up in consumer prices because businesses are eating it. That doesn't mean it isn't showing up. And so there is inflation seemingly percolating in the U.S. as well. Now, in the coming hours, we're going to get an inflation update from the UK. And here, we're actually looking for quite a significant jump in price growth. The headline number expected at 3.3%, which would be the fastest since February 2024. The core level seen at 3.7%, which would be the highest in 4 months. 3 months, let's say. Now, what's interesting is we just had a Bank of England rate decision. It was a cut. And what we find is that since that rate decision, the actual curve in benchmark SONIA futures that anticipate where policy will be heading became a little bit less dovish. So here was the curve at the meeting. Here's where it's moved now. So rates are seen a little bit higher now by year end than they did here. Moreover, we can see that this is a little bit more of a dovish setting than what was there at the middle of March, so almost exactly 2 months ago. And the upshot here is that the amplitude of speculation has really narrowed. We're kind of in this narrow space here where it looks like expectations are relatively well anchored, and though the Bank of England cut last time, scope for ongoing easing seems relatively mild. Again, this was the same story as we got from the Bank of Canada today. Headline inflation was weaker, but we looked through that to the pop happening in core, and what do we get? Higher yields, less scope for Bank of England rate cuts, not more. What have we been talking about with the Fed? Policy expectations there have unclenched. We are now back to basically 50 basis points for this year, 50 basis points for next year, in line with Fed expectations, whereas at the peak of the panic in April, we were looking at something closer to 140 basis points this year and next. So we've shed nearly 2 rate cuts. And so the story seems to be that inflation is starting to pop up in market after market, in country after country. It seems to be starting to happen at the core level. So it's not the kind of one-off thing that you can write off, dare we say, as transitory. And that all of this is happening is understandably pushing central banks back in their intent to cut rates, or at the very least anchoring them in place. As a matter of fact, the Reserve Bank of Australia just cut rates overnight, but the Australian dollar couldn't really sell off on it in any kind of a lasting way, and just stuck inside its range. The central bank lowered its growth and inflation expectations, which is why the Aussie did anything, it would seem, because of course the cut was widely expected. But the language from the RBA clearly signals this is not a cut that is a response to negative economic conditions. This is a maintenance cut. We'll see if we need to do more, but we are now well positioned to keep inflation as our main focus. And so, again, you have a central bank that's acted, but that looks reluctant to go again. And what makes this such a difficult backdrop, rising inflation and reluctant central banks, is that on the growth side of things, things are actually deteriorating. in April, as we've talked about before, we have this global PMI reading from S&P Global and JP Morgan. As ever, these are in terms of a diffusion index where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so looking at this composite index here in the blue, what you see is that since early last year, the trend for global growth has been deceleration. And it's been deceleration to a point where, as of April, we've landed on the weakest performance for global economic activity growth in 17 months. We're back to here. Now, on the manufacturing side, there's been a little bit of a pop from late 2024 heading into 2025 around the front running of tariffs. This makes sense, of course. If you know, as of November, that Donald Trump will be the next president of the United States, and he's spent the better part of 2 years campaigning on tariffs, among other things, of course, but certainly loudly campaigning in favor of tariffs, well, you may not know what's going to happen with those tariffs at that point, but you do know that if you can build up inventory at the old tariff prices, U.S. tariff before all of this was on average 2%, well then sure, you're going to go do that. You're going to max out your orders and you're going to squeeze in as much as you can. So it makes sense that there's a pickup in global manufacturing activity against this backdrop, but that seems to have run aground already. Already come March and April, as a matter of fact, it seems like that influence has faded. But the decline in services, that continues. And it's taking the overall pie lower. Now, it's not difficult to unpick which part of this is the culprit. As we've said many times here before, global growth is really contingent on just 3 economies: the U.S., the Eurozone, and China, which collectively make up 58% of global GDP. And moreover, the remaining 42% are mostly vendors to the former 3. So think Canada and Mexico with the U.S. Think Central Europe, Nordic Europe with the Eurozone. Perhaps to some extent even the UK. Think commodity producers from Latin America to Africa to Australia for China, and of course most of Southeast Asia. So these are the 3 economies that really drive the engine. And when you look here at what's happened over the course of last year going into this year, is the story in the Eurozone and China has been becoming increasingly more anemic to a point where, again, this is in PMI terms, they've converged on 50. So standstill. We have both versions of China's PMI data here, the official version, CFLP, and the S&P Global version, which matches the ones from the US and the Eurozone. Both of those are the S&P Global numbers. And you can see here, all of it is telling the same story. The pathway is a little bit divergent in spots, but we've come down to standstill pretty much all around. And the real major change that's occurred here is that the U.S. numbers, which were very strong up until the end of last year, they've fallen off and they're converging on the same standstill that everybody else is experiencing. Then, of course, comes the most uncomfortable question of all. If growth is slowing, who is coming to save it? Because if inflation is rising at the same time, and central banks are reluctant to act, well then they're not going to ride to the rescue until something so untoward occurs that they have to come and chase it. That, of course, puts the current macro backdrop into quite the dangerous setting. Because what it means in practice is that central banks don't want to cut rates. Fiscal authorities are not really in a position to act quickly and aren't really the vanguard of being front and center on making painful economic decisions. Meanwhile, the backdrop is creating that scary divergence in growth and inflation that gets everybody whispering stagflation, and for good reason. It is a very difficult policy environment to navigate. Now, we're going to get an update on PMI numbers later this week, and we'll talk about that in detail tomorrow as those numbers draw closer. But if we get another similar story here from UK CPI, as we've now seen from the Eurozone and from Canada, and albeit with some smoke and mirrors in the US, then the overall picture is going to start looking increasingly defensive, at least as far as the backdrop is concerned. Going into these PMI numbers that ostensibly will show, and those are the expectations, that global growth remains in very much a defensive mood. Now, whether stock markets and other markets are prepared to care about this, that's another story altogether. But the evidence that something that is both recessionary and perhaps inflationary is becoming increasingly apparent, that's a gathering risk. And it seems a matter of time until the markets come to focus there. This is Macro Money for today. As ever, we are here right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Victor Jones in just 30 minutes time today for The Price of Truth. I'll be back with Chris for Futures Power Hour on Friday, and then back on Monday as I am every week. I'll be on with Victor for First Call alongside Tom on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. As ever, if you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here.
And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast. Option Trades Today. You listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bat.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
What is going on, everybody, and welcome back to Risk of the Week. Today's Tuesday. We're going to be putting on a new Risk of the Week, so we'll check out what underlyings we're getting into today. Before we get into all of that and the platform, do a little tour to market. Gus, my brother, how we doing today? It's Tuesday. The world hasn't fallen apart yet. I feel like not too much action so far to start the week, but how are we doing today?
Yeah, it has. Well, I mean, I suppose slow is all relative in times like these, but it has kind of been a slow start to the week. No huge event turning the market upside down. I'll tell you what I was just thinking about, man. Ilya does such a good job of plugging himself. We gotta get better about plugging ourselves at the end of these shows, man. We're here every Tuesday and Thursday, guys. I don't even know if people know it. But yeah, I'm feeling good. I've been nursing a back injury for like a week that has kept me out of the gym. Finally, got to lift yesterday, and I woke up this morning feeling good. So that's had me in a pretty chipper mood all day, I must say.
No, good to hear. I know those injuries, you never want to play with them. What happened, though, if I could ask?
It's my scap, my right scapula. I've heard it like 4 times a year for like 3 years now. It happens all the time, and it happens when I'm doing chest, which is very interesting. It's usually like at the bottom of bench or like when I'm deep in a fly, like when it retracts, I'll kind of feel it go. But this was the worst one that I've ever had. Usually it puts me out for like 2 days. This one I think it was 9 before I was comfortable hitting upper body again. But happy to be recovered, feeling better. I'm feeling good. Bob,
there we go.
Good to see you in chat. Also, shout out to Nicole, who earlier in chat said anyone giving price targets is no better than a tarot card reader. I agree. I
know Bitcoin's been flying. I know a lot of price targets have been getting hit there, but at the same time, that is a pretty good comparison, I will say. So especially getting into this week, I know we had the debt downgrade. That was over the weekend. We had gap down. But, we'll get into a little bit more of that. But do you have any opinions on that, Gus? Debt downgrade. What's going on with America?
On Bitcoin, you mean?
No, just the overall debt downgrade, but you can touch on Bitcoin too.
Well, I don't have any thoughts on Bitcoin, so I'm happy about that. You're talking about what, the new data?
Yeah, no, I was just talking about the debt downgrade that we had gotten over the weekend. Like, I know we were just talking about how it was pretty quiet to start the week. And pretty much, I'm just trying to steer away from the conversation of the Nuggets. I just don't want that to come up before we get into our slides for today. It's a very touchy subject. But, I know we got the debt downgrade shortly after the Nuggets got kicked out of the potential to go to the Western Conference Finals. So it's been tough. It's been a good week, Gus, to wrap that all into something short. Been a good week, just a lot of catalysts, and still recovering from that Nuggets loss.
Yeah,
so that's where we're at.
Yeah, I was thinking about you when they fell in that Game 7. It was never particularly close. Watch it? A sad case. Yeah, I turned it off at about halftime, and it got ugly. Switched over and watched the Preakness. Shout out to journalism, any of my horse racing fans out there. But yeah, rough way for the season to end. It's interesting now. I mean, this isn't good for you as a Nuggets fan, but now we are going to have a team that hasn't won in the past 7 years or whatever that stat is. I think we have 2 teams in the mix that don't have a finals, if I'm not mistaken, in OKC and Minnesota. I don't believe Minnesota's ever won a championship.
I believe the Knicks was like in the 90s or something like that.
Yeah, so my policy from here on out is just to root for the non-championship teams. I would like to see somebody get their first one. I generally tend to root against big market teams in general, which I know is not going to fall on good ears here now that I'm in Chicago, but that's always kind of been my strategy. I like the small market teams. I like some money ball, so.
I hear you. I like that. And as we jump into the slides here for the Risk of the Week, I'm gonna have to go with Minnesota. I think Anthony Edwards just has that dog in him. I know each team has their own superstar, has their own guy, that they're leaning on. But I think Anthony Edwards gets it done. And I think if he gets it done, I think he has the most upside than anybody else as well.
I agree. I think Edwards certainly has potential to be the face of the league. I think whoever comes out of the West is going to win it. But the Thunder are going to be really hard to get past. Pacers in 5. I'm rooting for the Pacers. That's for sure. Oh yeah, the Pacers don't have a championship. Oh no, they might have a championship. I don't want to speak out of turn there. They win a Reggie Miller championship sometime. I'm not sure.
I don't mean to disrespect anybody, but I totally forgot the East was a thing. Like I just been looking at the West. I don't even care, but no, I do have to say though, I was thinking the other day, and this will be the last point before we get into the risk of the week, but the competition, again, I know it can be a little biased, right? I grew up in Colorado. I'm a West guy. But I mean, the West is so much more stacked. And I think there's a lot more teams that really dominate. In my opinion, that's on the West. So I think the West has just been a lot more exciting to watch. I mean, you got to take down Braun. You got to take down Curry. You got to take down Jokic. And I know I'm even missing a few there. So, hey, shout out to the Knicks. Shout out to all those smaller franchises, too, getting their name out there. But, I'm going to have to rock with the West. I need to hear your thoughts, your call on the winner before we transition real quick, Gus.
Outright winner, I think it'll be the Thunder. I think it's just going to be the team that's been the outright favorite all season. Yeah, I think they're too deep. I don't know. The Minnesota defense is really stifling. I do think the Rudy Gobert acquisition has certainly paid itself off. Would love to see the T-Wolves Knicks final for that the trade storylines there, but I do think it'll be the Thunder. They're just too deep. They have 10 guys that can go out there and give you 20 on any given night. It's crazy.
I hear you. Well, on that note, we'll jump into the risk of the week. I know we got a couple more positions that we had put on this week. So again, we are live Tuesdays and Thursdays. We'll get into the risks that we put on, and we'll come back to update those this coming up Thursday. So risk of the week, need to get that updated a little bit too. And I know I still have a position on, we'll get to that, but I still got a position on an NVIDIA. I don't know what you've done with your position from last week, but we can get into that first.
Yeah.
What do you have for us today? Yeah,
I'm out of everything. I'll put that out there. Okay. Alibaba was mine last week. I tried to get contrarian and cute, and it worked, which usually is not the case for me. So pleased with that. But yeah, risk of the week for this week is Target. They have earnings tomorrow morning. Obviously, inherently risky situation. I have my trade up there at the top. Bear call spread. Bought the 97, sold the 95. Sucked to get a fill. Really wide spreads on these, but managed to get a fill home at a pretty reasonable price. But yeah, earnings tomorrow morning. In this environment, guidance is more important than numbers. I think everybody knows that by now. These earnings numbers don't really matter. It's your forward guidance and how well you believe that your company is going to be able to navigate this tariff environment and this ever-changing economic landscape. And Target is very susceptible to these tariffs. They get 25% of their goods from China, another 25%, so 50% of their goods as a whole being imported from other countries. There's a huge tariff burden there, obviously, when you're this reliant on imports. And so they're going to have to kind of restructure their entire supply chain. Credit where it's due. They have been working on this. They were getting 60% of their products from China outright, and then another additional 20% from other countries in 2017. They made a conscious effort to try to get that down below 30% by 2025, and they are hovering right around that goal. So they have been working on this. They realized this was a liability. I just don't know if they've done a good enough job before this, this situation finally happened. Analyst price targets are dropping all over. I don't really read into it too much, but there is bearish sentiment in the air. And there's scattered boycotts on both sides of the political aisle. None of what I'm about to say is a political statement. I want to be abundantly clear. But on one side, you have the right, who is unhappy with Target over previous transgender issues, LGBTQ inclusion, things like that. And on the left, you have people who are upset at Target's retraction of DEI practices that they put in place in 2020 as they're based in Minneapolis, and that was where the George Floyd incident occurred. So somehow they've made enemies of both sides of the political aisle. This is the Elon Musk masterclass, I suppose. But yeah, so very interesting there. That's going to continue hurting their sales. They've been sliding all year. They really have done nothing to recover out of this tariff downfall, which makes me worry it might be a little bit undervalued, and I suppose I'm getting some reinforcement from analyst price targets on that front. But it was at 144 in January. We're all the way down below 100 now. I don't see anything stopping it really until 90 from a technical perspective. So getting bearish on Target here. I feel that their forward guidance just has to be bad. I think it just has to be bad. I don't know any way they could spin this into a positive. So that's where I'm at.
Yeah. No, I hear you. I love it. The bearish call spread that expires May 30th. So I mean, that's pretty short term. That's what we have 10. About 10 days. Yeah, we got about 10 days. $2 wide. I did peep that, but 10 days. That's a pretty short time window.
It is. So. It is. I'm just hoping for the move tomorrow morning and hoping we can get below 95. I'm kind of straddling the money here. The top call is in the money and the bottom one is not. Well, other way, it's a bear call spread. Yeah, you get what I'm saying. But anyway, so hoping for a nice little gap down. Just need another $2, nothing crazy, down below 95. And yeah, like I said, I think if this is bad enough, we could easily see this dump into the 94 to 90 range.
Yeah, no, I mean, I like the pick. I don't trade Target too much, but I mean, Target is usually a pretty solid one, pretty solid liquidity. The premiums are pretty usually nice in there. I think it's been a little while. I think it's maybe been 2 months since I traded this one, but I like it. I feel like every time we hop on here, we're always having to consider, forward guidance, like you kind of mentioned, that kind of touches on tariffs. So I know we're kind of sitting in that time window of coming to a consensus on what we're going to be doing with tariffs and deals with other countries. But we're trading through the uncertainty. So we'll see how these ones pan out. I like Target, though. I like it. I like the pick.
Yeah, and in times of uncertainty, things like to go down, and I think that there's a lot of uncertainty surrounding this company right now. I'll also add that I think like every time I've ever tried to get long Target in my life, it's been a losing trade. So I'm switching sides.
Really?
I'm changing teams.
Okay, I like it. We'll see how that pans out then. I did end up going with gold today. It was a little bit of a different one out of the basket for today. But we went with gold. We're going to be selling an outright contract on gold. I just have to put out there, gold isn't one of the products that I have a ton of experience with trading. I know depending on what underlying you're trading, you'll kind of develop a sense of its kind of personality per se, especially you'll get attuned to certain, underlying's volatility levels, I guess you could say. And I think that's where that personality feel from each underlying comes from. But gold is a volatile one. So we're going to be getting short gold here. A few of the points that I wanted to touch on was just that gold is stalling here a little bit at all-time highs. No fresh catalyst yet to push it further. That one you got to take with a grain of salt. I mean, we could wake up in the morning, a tweet, geopolitical event, something could, we could have a catalyst out of nowhere pretty much. So I'm cautious of that. Real yields are holding steady, so not much of an appeal to start getting long gold at these prices. But I mean, overall, with all that even being said, before I touch on the last 2 points, mostly because gold went on an absolute tear to the upside is really why I want to get bearish. But these points make me feel a little bit more comfortable, kind of finding those pieces of evidence that kind of just, validate yourself. So that's what I was doing with these bullet points here. But without a crisis or breakout event, gold looks vulnerable to a pullback. So again, gold went on an absolute tear to the upside, and I want to catch a little bit of the downside if there's any downside left. Couple notes. Gold is $10 per point. I trade a lot of NASDAQ. I trade a lot of micro NASDAQ, and that's about $2 per point. So that's definitely going to be a pretty big adjustment for me just managing this trade as a whole. So kind of have my eyes on where I want to start managing this trade if gold starts to rip to the highs, because again, if gold goes 10 points against you, you're going to be down $100 just on 10 points. So just keeping in mind that multiplier for those futures contracts, and always having a stop loss in there. That's what I'm going to do just because of the size of my account. I know there's a whole conversation around not using stop losses, but then you would have to be able to, have a good cushion in your account to, not even have to worry about the risk management whenever trading the futures contracts directionally. But because of how volatile these contracts are, again, I'm going to be managing it manually. And then gold can move quick, especially around economic releases, Fed speeches, or geopolitical events, if I can speak. So because of that, I'm going to be very mindful of gold. I know some positions I can kind of just take a backseat approach. But with this one, I'm going to be hands-on. I'm going to be watching it. Might even set a couple of alarms tonight, check it in the middle of the night, maybe use some stop losses. But we're going to gold today, Gus. It's not as, I feel like you going like gold or silver, it's not as like sexy. It's not as cute. It's not as exciting, but we're going to be rocking with gold today this week. So we'll see how it pans out.
Yeah, I mean, I think when you manage to, harness this type of delta and beta and volatility that you're getting here, $10 a point is no joke. I think that it certainly still constitutes risk of the week and certainly is still enough excitement. Yeah, it's funny, the note about waking up in the middle of the night. I actually a guy, I told him how to do it, but a guy on Reddit the other day was asking about how to keep his MacBook from locking so that his triggers, when his trigger alarms go off, he'll wake up in the middle of the night so he can trade Forex. And I had to laugh at that. I told him, I gave him the pathing on how to do it in the Mac settings, and then I said, my advice would be to just trade during the 16 hours you're awake, big dog. Yeah. Like, you probably don't need to do this. But yeah, and then I also thought you made an interesting point in the middle there. there. Lots of very interesting discourse about stop losses right now. This is sort of a trending topic in the financial space, I've come to find. And yeah, I think it's very interesting. My policy is stop losses on the way up, but I never have an initial stop loss on a position, though I have the luxury of being able to watch my positions all the time. Everybody's situation is obviously different. But yeah, my take on stop losses, I love trailing stop losses on the way up. If something happens where we get some one weird candle of action and suddenly I stop out and then it goes right back up, I'm willing to live with that. It's still a profit. It's a trailing stop loss, whatever. I'm willing to take those L's where they come, and it's not really a loss if you wind up profiting on the trade. But yeah, on the way down or like right off rip, it can be kind of nuanced. Sometimes things can work against you for a little bit. Maybe something is channeling and you're waiting for a breakout to the top side, and you're buying in anticipation of that, and then it's going to go through the channel one more time. Things like that. So yeah, it's very interesting. I don't know what your thoughts are on it.
Yeah, no, again, I know Dr. Jim, he'll kind of have the opposing view. Like, he'll kind of laugh too whenever I talk about a stop loss too. So I love having that discourse with him. But I'm kind of the proponent of, and Dr. Jim did make this point. Whatever your process looks like if you use a stop loss, you got to use a stop loss every time. If you don't use a stop loss, it might be wise to not use a stop loss every time. Like, you got to have some type of consistent approach, or you might hold on to losers and then cut it. And then you also might either cut trades too early or hold on to them too long. And if you're going back and forth juggling those two things, you could catch the bad end of the stick. So whatever you do choose, I'm kind of the proponent. Make sure you're just consistent with whatever it is. But at the same time, I do think there's going to be a point in your account, even if you don't use a stop loss. Like, I do feel there's going to be a dollar amount that's going to get you like, okay, maybe I need a call. Maybe I should cover this position now. Like, I think there is going to be to a point, and even if it's a 10% chance or a 5% chance, it's not a position that I want to end up in. Even if there's just a 5% chance, I like to cut my trades fairly quickly, trading directionally. But I mean, especially in this environment, just seeing the market run 300, 400, 500 points in one direction with no mercy, no window to get out of the trade. I just think to myself, like, yeah, one micro contract, that's not too bad. But especially with my account size, I don't know if I could stomach that. I don't know if, at 500 or 600 points, I might want to start definitely cutting this. And I've seen the market rally over 1,000 points in the span of less than a 5-day trading week. So this market environment, I don't know. I think it's just dependent on what type of risk you're comfortable with. So all that to just say, I'm on the side of using a stop loss, but at the same time, whatever approach you have, be consistent with it. That's kind of where I'm at with it.
Yeah. I mean, I think you certainly raised some great points there, and I don't know. It's interesting. Everybody does things differently, and I mean, there's also people who will use profit targets and get out at the top. But I don't know. For me, it's like in terms of not using the stop loss initially on the way down. I feel that it's just if you trade the tasty way, if you trade small, you trade often, you use a lot of defined risk and take advantage of all these wonderful strategies that we offer in the platform. Most of the time, if a trade went to zero, I would just be okay. Like, obviously, I don't want that to happen. Right. But I'm never so overexposed. I never have so much portfolio allocation into one thing that something going to zero would really hurt me that bad. So I think that's important too, and something that I should note when I say I don't use stop losses. If you're always trading naked, undefined risk, there might be a lot more utility in that case.
100%. And I know sometimes I'll trade directionally using some of the just buying some of the contracts outright. And I will still use a stop loss. I know it sounds crazy, but I'll still use a stop loss even if I'm trading a 0 DTE options contract. I'll just put a stop loss on the contracts themselves. But I did hear the other day, somebody, I forget where I'd seen it, but some people, will size the position to what they're willing to risk, even on a 0 DTE. So as we know, when you buy options, your risk is a debit that you paid for the option. So if you're only willing to risk $200, you can pay a debit up to $2, and then you would essentially be saying you're okay if that were to go to zero. So I know some people, price their positions that way in terms of 0 DTEs, because I know it still has the theta element to it. But if you're trading a 0 DTE, you're almost trading pure direction, really, at that point, if there's enough volatility. But anyways, as we transition right here real quick, Gus, we'll get into a few of these positions that we have on. SPY, short position, 31 days. Not looking too hot. We do still have a month. Things can change really quickly. I mean, the beginning of April, we were down at the lows, and now we had like a capitulatory move back to the upside. One of the most insane things I've ever seen. So we'll see what happens. QQQ got a position, bearish position that expires by the end of this week. Need QQQ to be below 523 by Friday. Maybe I take this one off if we get some type of decent sell-off come Wednesday or Thursday. Maybe I then take it off. NVIDIA, this was the risk of last week. We put on a short position in NVIDIA. Down $47. I like to kind of call that break-even-ish, kind of been flopping between, plus or minus $50 on that position over the last week. So still got to let some time run on that. 31 days. None of the contracts are in the money right now, so I can be a little patient there. I do have a swing position on the micro NASDAQ, and I was a proponent of not swinging these contracts just because when I swing futures contracts directionally, like a lot of the time it messes up my entire momentum with some of the intraday trades that I make, whatever. It's like I'll build confidence trading intraday, and then it's like I'll use that risk to swing, and then I just like get walloped swinging the futures contract. So that's where I realized I would typically start losing money is when I start swinging these micro contracts. But I got a really great entry on NASDAQ, and I think it really reflects my bias right now in the market. So I'll touch on this one real quick and kind of just show where I'm risking on this one. I put this one on yesterday. And I'm going to be risking towards these highs. So come tomorrow or come sometime throughout this week, I'm essentially risking about, I think it was 60 points it was. Let me zoom out just a little bit more. I'm risking towards these highs that we had put in. Let's see if I can get this correct. But the short position is at 21,499. We're going to be risking to these highs that we had put in yesterday. So, excuse me, this is going to be about 63 points worth of risk to be exact. So if I'm risking 63 points and it's about $2 per point on the micro NASDAQ, I'm risking about $120. So even though this is a directional trade, even though I'm swinging this futures contract, I do know my risk is defined. I'm going to be cutting the trade when I'm down 63 points. When I do the math on that, I'll be down just a little bit over $120. So if we can keep selling off throughout the rest of this week, I'm bearish. So maybe we can catch a decent profit on that. But that's going to be that for NASDAQ. Risk of the week, last one here in the portfolio is the gold contracts. I will say I was really fortunate for this move. I put it on and then the market sold off. I was like, okay, bet. Gave me a cushion instantly, especially with how the multiplier is on these gold contracts. So sitting in here up a little bit on this, even though we put it on today, we're up about 64 points on gold so far. So I'm going to be looking out for it. We barely had a dip, and I'm up 65 points. That just kind of shows you the multiplier on this contract right now. So really going to manage that, but that's all I got for you right here, Gus.
Yeah, interesting. I like it. And yeah, I think it's always good to get into the weeds and be doing that math and doing those calculations. That's something that if you can, if you can get that going on autopilot in your brain every time you're making a trade, that's definitely a lot of strength. On my end of things here, I don't know. I don't really have anything particularly new. I've been mostly just taking profits. Kind of bringing some capital back in. I've gone from, which this is kind of absurd, but we're in absurd times. I've gone from about 70% of my capital deployed into about a little bit less than 50% right now, which is good. I mean, closer to 40 actually. So yeah, just been reeling it back in, taking some profits. I made a nice little trade on trip.com that I did not nearly enough due diligence on yesterday before close. Got short there before their earnings call today. Big dip this morning, got out there. But my shining star, my sweet prince is Rivian. Holy cow, has this thing been printing me money every single day. Look at this chart. This is the greatest chart in the world if you're long.
Oh my gosh.
Are you kidding me?
This man got long.
Are you kidding me?
Of course this man caught this move. I'm telling you.
Yeah. So I'm like low 15s is my entry on two naked call leaps that are 486 DTE, but I have a 12 and a 20. And yeah, that has been a money printer, has been keeping me afloat as things kind of ping pong around. But yeah, Rivian is on the freaking move. So this has been
no pun intended. The dad joke. You didn't even mean you're such a dad. You didn't even mean to do that one. On the move.
It's true. Rivian is rolling. But yeah, so that's certainly been the big one, making me some money recently. Google also. I have two Google longs that I just need Google over 150, which is crazy that it's even starting to look like that might be in the equation. But I bought those.
Wait, you need Google above or below 150?
Above 150.
You're a big cherry.
Yeah. So it's crazy that 150 may even start to re-enter this equation. I really thought I was good when it just ripped up to 165. But that's looking good. Bought those way at the bottom. Those are June 6th, which is 17 DTE. And yeah, that's been a big income source for me as well. But yeah, just trying to get some risk off the board and get all this capital hoarded again to deploy whenever the next volatility event happens. And I'll tell you what, Errol, today I was super close to just blindly getting long the VIX. I could feel it in my bones. I don't know what it is.
I just pulled the VIX back up. Come on, brother. We got to have a pop anytime now. I know you feel it.
It must happen. I can feel it. It's in my loins. But I just, like I say, VIX below 20 in this environment, I feel like I just should blindly get long. I've been holding off this entire time because I don't want to be too stupid. But with every passing day, I get closer and closer to buying this. So I will probably be long some VIX by the end of the week, just as a fun little, one-off on sentiment. I mean, what if you're holding a VIX 20 call and this thing goes to 60 again? All of a sudden, it'd be crazy. So in this volatility environment, I feel like I want to get long VIX right now.
Did you just insinuate we're going to, what if we get another market crash? Pessimistic, Gus.
I'm not pessimistic.
What if we pop to 60? Like, that's just right around the corner.
I'm not long yet. It just could happen.
We crashed again.
Chat agrees with me. Next vol event is coming. It has to be coming. I'm telling you. Thank you, Lone Sophos. But yeah, I don't know. I can feel that. So itching to get long some VIX. I'm going to have to take a flyer there sometime before the end of the week.
No, I love it. We'll see how this pans out. I do hope we get a pop in VIX though. So looking forward to that. We went over all the positions. We'll see what we get the rest of the week. I know today was really choppy. The market didn't start really moving until like the last 2 hours of market close. We sold off and then we got bought straight back up. So we'll see what we get for the rest of the week. We haven't made any meaningful type moves yet. But anything to add before we hop on out of here today, Gus?
Yeah, no, nothing. I actually just had to check to see if SPY even closed green or closed red because it did get a little choppy there at the end. But yeah, cruised in sixth. I think that was 6 straight green days we had before this one. So yeah, bound to get a red one sometime. But yeah, and this whole VIX thing, it's nuanced because for all of my other positions, literally, I would like things to continue upward, but I can't help but feel like the next vol event is coming. So that's where I'm at. ES goes above 6K first, though. Exactly what I'm thinking, Lone Sophos. We're going to go to the moon. I'm going to pull all my money, and then the market's going to crash, and I'm going to be long VIX. Oh, man.
I love it. We'll see how these things pan out the rest of the. It's gonna be so funny if we get that tomorrow. I'm gonna literally laugh if we get that tomorrow. We'll see. But that's gonna wrap it up for today's segment. Thanks for taking the time to hang out with us today on Risk of the Week. We will be back here Thursday at 4:30 Central Time. We are here every Tuesday and Thursday, where every Tuesday we put on a new Risk of the Week, and we'll keep everybody updated on how we're managing those trades, what we're putting on, the whole 9 yards. So thanks for hanging out with us today. Today it is Errol and Gus, and we'll catch you guys next time. Peace.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. And I think that left a door open for us, which we really liked. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving from kind of traditional open outcry to electronic trading. I saw the writing on the wall, and I wanted to be first.
Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. Most of our competitors have legacy technology, and some of them are multiple firms. Their technology has just been rolled up into a single platform. That's not the best way to build a platform. We built ours literally from scratch. It's from the ground up, so we were able to design it in the way that we wanted to design it with the flexibility that we wanted. And obviously beyond that, we do have, in my mind, the greatest customer service in the industry. You want to reach out to me, you want to talk to JJ, it doesn't make a difference who you want to talk to. We're always available, and not only are we available, we look forward to your questions. We're here to support whatever you're looking to do. So you can trade stocks, you can trade options, futures options, crypto. We're agnostic to product. We have the tools that you need to be a successful trader.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
I think I went down the typical path of investing in stocks, and I was really frustrated in the sense that it was a buy and hope type strategy. And so I was looking at, different ways to learn about options, and I saw Mike and his whiteboard, and it all made sense. There's another world out there with options. It gives flexibility. It's more capital efficient, and tastylive does it again. They teach it in a way that is fun, it's easy to understand, and you're learning from people that have done it for 40 years.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market. Never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Oh, yeah, it's Tuesday, May 20th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. Shout out to everybody watching on tastylive.com, as well as all of you watching on Tasty Trade desktop and mobile applications. But if you want to be part of Bing, did I get it? The chat box in the middle of your screen, there's only one place you can do that. That's on the evil, kind of cheap Google YouTube. So head on over to Google YouTube. I knew you'd like that. Head on over to Google YouTube. Head on over to Google's YouTube. Subscribe to the channel. Start moving those phalanges, those metacarpals. Smash your skull into the keyboard as long as random ass characters are forming in that chat box in the middle of your screen, so we can spoof the Google algorithm into putting us in front of as many people as possible. Ugh, that's a mouthful. Today, it's Tuesday, my babies. You know what that means. It's time for the one, the only, the incomparable Mr. Ilya Spivak. Ilya, how you doing, my friend?
I'm doing well. I'm sitting in a death trap of an ergonomic chair, trying to soothe the back that I threw out for absolutely no good reason whatsoever, and picking through CPI statistics all day today, which is a fun time if you like that sort of thing.
It's a fun time. You know, I think it was last Wednesday, Chris heard himself reading. You threw your back out doing nothing.
Nothing.
Like I think we're officially old, Ilya.
It's crazy because you'd think you'd sustain some kind of a something, at least doing something, but no. Chasing the kids around the park, no problem. Exercise, no problem. Go to sleep, wake up the next day, you're all messed up.
A hard sneeze will do it for me. I've gone to the hospital after a hard sneeze, my friend. I've got questions. Hopefully you've got answers. Ilias Bivac, 59.
I am Radio Shack. Let's do this. What's funny is actually I used to work at Radio Shack for.
I totally see that. I was
a Radio Shack sales associate for.
There's two types
of. 4 months there.
Oh man, then the answer to this is going to be no. But there's two types of Radio Shack associates. There was the one who was just kind of like, you're there for the paycheck. Then there was the other one that was sort of like had a hot glue gun. They had a couple of like low voltage DC motors, and they were making their own robots or kind of contraptions at home. You get what I'm saying? Which
Absolutely.
One were you?
So my friend whose job it was that I was caretaking for him, he's the hobbyist type. He wanted he's an audio engineer, and so he wanted all the cables and adapters and all.
Building his own ham radios.
Yeah, building like a recording studio and all these kinds of things. But he needed his job babysat over a summer while he was on the road, and I needed a job, so I babysat his job for about 3.5, 4 months.
See, those were the old days. That's when a job was fungible. Anyone could show up.
You could go to a store manager and go, "Hey, you see this Russian? Let him sell cell phones for a while."
All right, as long as somebody showed up, I got no problems. See, I had this whole argument yesterday. I said, before we get into it, I said, like, Netflix back in the day when they mailed you a DVD. You could give that to anybody. Once you got the physical DVD in your possession, you can give it to anybody. Now, because it's digital, hey, man, if we're not sending it straight to your house, if it's going to any other household, we can tell it's going to another household, and you need to pay us. You need to pay us an additional household fee. So the more we get into a digital world, my friend, the more control corporations have.
I mean, yes, but also... the more avenues there are to circumvent that.
Yeah, I mean the road to hell's paved with convenience, my friend.
Yeah, I mean the game continues to evolve. I mean, first the internet happens and everybody goes, "Ooh, Napster," and then right?
Free music, everybody.
Right. Free music, free movies, free software, and then the other side goes, "I see your Napster. I will counter Netflix household fees."
No, bro. You thought this was free music. Really, we are now surveilling you. We can tell when you go, where you go, what you're saying to all your friends and family. Yeah. We thought this was free music at the beginning. It ended up being a way to tag and bag us.
Yeah, we'll just charge you for going to the concert now, and you all can stream everything on the streaming service of your choice for next to nothing. Godspeed.
Napster, what a great reference. All right, my friend. S&P 500, 5940. VIX up just a little bit. VIX future I'm talking about.
Yeah.
Excuse me. There we go. 1960. VIX cash it a little bit over 18. Mm-hmm. Who would have thought? And the bonds at 112. I honestly, there's a part of the way assets are moving, my friend, that it's hard for me to sort of understand. Bitcoin at 106,000. So in a way, risk appetite rising, but then on the other side, you've got gold that's rising at 3,300. Mm-hmm. You know, is there risk
today here?
What's that?
Nice pop in gold.
Yeah, today. Nice pop. Is there risk in this market, or is there risk aversion in this market? You explain it to me. Use the assets here. I can pick. You know, I look at bonds. I get one story. I look at gold. I get one story. I look at Bitcoin. I get a different story. I look at risk assets. I get a different one. Maybe I look at the dollar. I don't think risk assets are telling the same story. Elliot, explain it to me.
I don't think they are. I think you're right. There's the stock market in my mind, and then there's everything else. And if you look at everything else, it makes a little bit more sense. So let's just put stocks off to the side for a second. And we'll get to them because they seem like the odd one out. So crude oil doesn't manage a run. Neither does copper. Gold is up. Bonds try to sell off, but ultimately hold it in their range. The dollar sort of errs on the side of weaker, but ultimately doesn't run away very far. In fact, that euro chart you've just pulled up looks very gold-like in its structure. But you look at all of this and you go, okay, so where are we? We have a US dollar that's weaker, bonds that aren't managing to hold a rally and seemingly can't even do it on a US downgrade, that they're really holding the line here. So interest rates maybe are topping. Gold is rallying, which sort of reinforces that idea. Growthy stuff can't really find lasting support, whether it's crude oil or copper or sort of other similar things. So you get the sense that there is a kind of cyclical discomfort. You don't get it in stocks unless you want to say that today's down move means something. And it's very difficult to say that because it's one day. It's after a really long run higher. There's no news today. Nothing to really hang your hat on. It is marginally interesting that the market had a default to pick today in the absence of news, and the default it picked was down. But also, it's been rallying up a storm. So how weird is that? Not very. Right? That doesn't necessarily mean that the markets are capitulating or anything remotely of the sort. So it's an interesting sort of setup. And for me, I go back to this idea that what there is in the stock market is more sentiment and kind of a vibe-driven sort of thing, because we created a giant, scary thing, and at the last minute, at the 11th hour, Rocky got off the mat, and now everybody's cheering. Like, the Liberation Day thing was a completely self-induced kind of a panic. In the sense that, I mean, I'm not suggesting the administration knew the markets would panic. I'm suggesting without that announcement, a lot of the explosion involved that you see in April does not occur. So you get that announcement, the markets go, oh my God. And then they unclench. But has anything actually changed? Not really. Not in the sort of upshot. The average U.S. tariff still has gone up 5-fold. That's in the best case scenario, that the new floor of 10 is applied universally, even to China, when it's all said and done. Global growth is at the weakest in 17 months, according to the latest PMI numbers out of S&P Global that take in everything, and we'll get an update later in the week. And the data that we're starting to see on the inflation side, we got some more this week from the Eurozone, from Canada today. We'll get the UK tonight. It's starting to suggest that inflation is coming back. And break-evens in the U.S. bond market seem to agree, even though the market was all kinds of happy with what looked like normal CPI out of the U.S. Once the PPI numbers came out and showed you that it's not that there's no impact to inflation. It's just consumers are being shielded because businesses are eating it, and it's all being held up at the wholesale level. And the bond market looks through that and goes, yes, so there's inflation. It's just not showing up because it's not getting passed on. Home Depot told us just this week that they are not passing it on, whereas let's say Walmart is. So you get this sense that if you wanted to be worried about stagflation risk, you're starting to get some evidence that's looking meatier, and it's looking meatier in all kinds of spots. So not just the US, but also Canada and the Eurozone and the UK, likely. The vibe shift out of Australia was very interesting as they cut rates, but then said basically, okay, but this means that we don't have to do anything else probably for a long time. So you get this sense that on one side, the markets are having a growth concern and an inflation concern on top. But stocks are still reveling in the finger was on the self-destruct button for the global economy, and now the button is back in a drawer. Woohoo. But at some point, they will start to care. It's just unclear when. And so you get this bifurcation, and the market feels weird.
Weird is the right word for sure. You know, I'm looking at you know, a lot of these risk assets, a lot of the overextended stuff, and they're off, but just a little bit. You know what I mean? Like,
yeah,
I think the S&P being down just like 0.2% today, it tells the exact right story of what happened with risk. Sometimes that happens. And what really happened is a bunch of stocks were down big, and it was offset by some other stocks that sort of did well. Across the board, there was just kind of this, let's take a little bit off. Let's take a little haircut.
Yeah,
on a lot of equities across sectors.
It wasn't a growthy mix today.
It wasn't.
Staples outperformed, healthcare, utilities. Everything else is down.
Correct. It had that feeling of perhaps an equity rally that's gotten a bit long in the tooth here, and I don't want to give up on this thing, so let's go buy the defensives here. Maybe they're cheap on a relative basis.
Yeah.
And like the miners, I'm looking at Newmont Mining, which had been blown up over the last couple of weeks as gold took a little bit of a breather. Gold had a small pop, but the miners were up 2.5 to 3% here today. To me, that's not a market that's like going, get me the Mag 7s.
Yes.
You know what I mean?
Super glide, baby, let's go. Yeah, like that's not what this, it doesn't feel like that.
Miners should be down another 2% today. You know what I mean? And even if stocks are just hanging out here. We talked about miners the other day as a potential opportunity. Newmont looked relatively cheap. The reason I'm bringing it up, it looked relatively cheap at 48. Here's my question to you, Ilya. We're going to be more actionable today with our conversation.
Okay.
What are you doing? What are you doing with risk? What would you do here with equity risk at 59.40? Are you firing against this thing, and if so, how?
I'm not firing anything new. So I started layering on short exposure via put verticals. I clearly got it at the wrong time. I've been sitting on these things for like almost a month already. They're at max loss, and I still have like 30 days of duration in them because I went in clear-eyed going, who knows where this thing is going to hit a wall. But if I'm expecting that it's going to hit a wall, I need to be risk defined. I need to give myself tons of duration, and then we'll see. If in that time you can structure a trade and it doesn't take away anything crazy from your account, even if it expires worthless, okay, lock it in. I've done. I have a NASDAQ that way. I have the S&P that way, and I'm not putting anything new against it because obviously I already have a bunch of dead capital tied up in these positions, and we'll see. There's another 30 days. We'll see. If it starts to really turn, if let's say you get the S&P back through like 5,800 or something like this, or into even the mid 5,800s through, let's call it 5,900 and through like 5,880, 5,870, I might add in and go, okay, time to average in. There was something there to kind of address the timing. Now the timing seems like it's there. Let's hit the gas a little. I sold premium and gold today because I felt like it picked a direction. It seems to be going higher. It seems to have room, let's say, to test the top of its range.
You sold premium and gold, meaning what? What does that mean?
Meaning I went short a put vertical.
Yeah.
So basically got long side exposure by selling puts because vol was a little high today, and so structuring decent risk reward on a call vertical, buying calls just looked like it was going to be too expensive. It was,
the way you're participating in risk in equities is really similar to what I'm doing in bonds, but directionally the opposite. So I have, I'm taking a stab at the upside in bonds.
Me too.
Because it's the opposite of what the narrative says you should do. What the narrative and what sort of positioning says you should do right now is you say, all right, equities are showing a completely different story of growth and inflation. What one might expect then is for bonds to price in basically a steeper curve. You would look for a steeper curve potentially, and then, or at the very minimum, you would look for higher yields in the back end to say like the market is pricing in more growth and inflation in the back end. But I think the story is going to be more nuanced than that. I think with higher equity prices and with higher growth expectations, with higher inflation expectations, what ultimately happens is you can't price as many cuts in the front end of the curve. And so we've seen that. We moved off of 4 cuts on the front end of the curve, now down to 2. And some part of me thinks we're going to flirt with going to no cuts in 2025. I don't think that's the reality, but I think the market has never known how to price cuts. It just goes all over the place. So I think they're gonna take at least. I think the market may flirt with the idea of taking one more out, and so we get to the idea of none to one. I think you and I have talked.
And then they go into the long end because the market goes. There's a growth slowdown.
Correct.
You all are out of your mind.
Yes. There's a reflexivity. There's a reflexivity that's happening.
Yes.
There's a reflexivity that's happening, which is you take the cuts out because growth and inflation, because the risk of growth and inflation. So you take the cuts out, and then you go, this isn't good.
Yeah. But growth is slowing. Hold on now.
No. It's the opposite. It's when growth and inflation expectations go up, then they take the cuts out of the market. Then they realize, oh shit, there's no cuts.
Right, but the extra scary part in this moment is it's that, but growth isn't going up.
Right, but then
it's like double scary.
Kind of, but we've already done the opposite part. So then what happens on the flip side is you go, oh no, a growth slowdown. Then you price in the cuts. And then you realize, like, oh shit, we've got 4 cuts here.
Yeah.
After equities cool off, you go, there's room to be a little bit more bullish, and it's just this funny kind of stabilizing mechanism. And you go, did the Fed put themselves in the exact right spot here to sort of like manage this? If you get an exogenous shock, that's clearly going to throw them off balance and equilibrium. But this thing is kind of working, and nobody says that.
Well,
you know what I mean?
Except us, right? We've been talking about Fed judo, about how what the Fed does here is rather than fight the markets, it's trying to keep them off balance so speculation doesn't run away too far this way or that. And it's working. It's been working.
It really is. It really is. This whole idea of like the Fed has a very limited set of tools, and really what they had is forward guidance. And man, they found a way to put themselves in this position where they're using the limited set of tools that they have to their maximum benefit right now. I've got to say that. Like, I think they're doing the complete wrong thing, but for what their objective seems to be, it is working.
I mean, if your objective is, as stated, right, price stability in a context of the maximum employment you can achieve without that price stability being upset, right? That's your mandate. You have to justify now and forever, until the mandate changes, why what you're doing is that. And if you don't justify it, then you're not credible, and then the markets won't believe you. And if the markets don't believe you, you have no more power, you can't do anything. Because the central bank is not able to just mandate interest rates in the economy. The economy has to follow. The central bank sets a target. It has to be credible enough that that's the real target. And everybody else across the economy, across all the many layers of borrowing in the economy, has to take that as its North Star. And if the central bank isn't credible, they won't. And you go back to the free banking chaos of what there was before there was a Fed. A story of constant bank failures, constant currency crises, and in fact multiple currencies. The Fed was created to address this issue.
Can I ask you a question? All right, sure. You did it, man. I was just going to have a nice, clean show. You and I were going to talk about price levels. I'm going to... Okay. God damn, you're going to get me fired, Ilya. I don't know what's up with me this week. I'm going into all this weird territories that I should not be talking about. Ilya, do you think governments chose the right mechanisms in hindsight, with the benefit of hindsight? Do you think governments chose the right mechanism to deal with COVID?
I think that is I don't think that's a yes or no question.
Yes, it is. I think it is. I don't think it is. Do you think mandatory lockdowns that people saw in Australia, that version of it here?
I don't think those
in China. Do you think all these governments, regardless if they were democratic, regardless if they were more communist leaning, authoritarian, totalitarian, in general, on balance, do you think the world's governments chose to handle COVID correctly?
I think, again, it is not a yes or no question. I also think that it is now general consensus that, and rightly so, that the kind of lockdowns that there was did more harm than good.
Bro, like, I don't understand. I just don't understand why we as human beings make stuff so complicated, why we do mental gymnastics to try to justify.
Because you cannot know
the way somebody else handled themselves.
Whether a policy is good or not.
I asked you, with the benefit of hindsight, if we got into another pandemic that looked the exact same, with a virus that had the exact same characteristics, do you think the world's government should act the exact same?
No, of course not. And I think that's general consensus now. Of course not. But lockdowns were not the only aspect of the policy response to COVID. That's why it's not a yes or no question. Governments did all kinds of different things.
What do you think, if we did not have, if like the central bank wasn't going to be there to print all this money, and I'm using print as a hypersimplification, but you understand what I'm saying.
Right.
It enabled our government to do what they did. Do you understand what I'm saying?
No, absolutely. Sure.
And so in effect, it enabled our government to make poor choices. And
you're making a rhetorical jump that I am not. And Maybe you're not. So let's see if I'm understanding this correctly.
Sure.
It sounds like what you're saying is that central banks and the government made bad decisions in their management of COVID, that the essence of these bad decisions was governments, whether you want to say that they did this for whatever reason, but their response was an incorrectly draconian response,
enabled by,
and that the way that you were able to turn off the global economy, basically, to affect that draconian response, was central banks aggressively cut interest rates.
No, it's just
provided,
it's like, I'll give you
oodles
a simpler,
of liquidity.
Yes, a simpler example would just be if the only way we went to war is if we paid for the war up front, then we would have had less wars over the last 20 years.
No.
So in a way, this mechanism, I'm not saying it's bad. What I'm saying is it enables our government to make bad choices. It's not the cause of their bad choices, but enables them to make bad choices.
I don't think I don't think there is anything to be surprised by there. Because if you are a central...
I think that's true.
And the reason is because you create a central bank inherently, right? In its kind of modern iteration. And let's take the U.S. The Fed is, in its conception, counter-cyclical. It is meant to be fighting inflation when growth is hot. It is meant to be stoking inflation when growth is weak. So if the government does something dumb and hurts the economy, it isn't collusion that the central bank enables them. It is the correct response of the central bank to economic weakness. No, I'm not saying you're saying that. I'm saying it's very easy when you structure it without explaining for people to jump to the conclusion that there is a cabal of policy making. I'm not saying you're saying that.
I don't know why you're even bringing that up. All I'm saying is
because it's a very loud argument out there, and it starts with the Fed enabled the government to do something dumb.
They do. I think that's undeniable. But I think the nature all I'm saying, of the central bank, is you started this conversation sort of expressing the virtues of the central bank and how it's enabled us to come to some enlightenment period
it enabled us to stop endless banking panics
versus all these banking crises. And I'm simply saying, okay, yes, and I'm saying yes, and
I agree.
Acknowledge the other side of the coin.
No, I agree with you. I just don't think that is in any way besmirching of the central bank. And so to say again that,
bro, yes, it is. It's a matter of incentives. We have turned every crisis into an opportunity so that when things aren't an actual crisis, they become giant crises, specifically because the incentive behind taking advantage of a crisis. When a crisis shows up, bro, why wouldn't you over-rotate, spray and pray? Why not?
So again, if you go and you look at the central bank's role, right? Its role is to be counter-cyclical, and that is its normal role. This isn't anything that you wouldn't expect. So if the government does something dumb and hurts the economy, and again, maybe it was dumb because every crisis is an opportunity. I'm not saying that's their mindset. I'm not saying it's not their mindset. I am not someone who believes that, oh, they got a virus and then they purposefully shut down the global economy because they wanted to do that. I don't think anybody wanted to do that. I think any self-preserving politician would be an abject idiot to want to create the pitchforks and torches where they don't have to exist. But not to say that the government doesn't do abjectly idiotic things. It absolutely does. So I think the issue isn't what the motivations of the government were or weren't. The issue is that what the government did, and not just in the US, but everywhere, they shut down the global economy. And central banks, whose job it is to be counter-cyclical, responded in the counter-cyclical way that you'd expect. They did their job. They did exactly what you would expect. So I don't put that on the central bank's shoulders as saying they did something that they shouldn't be doing. If anything, yes, governments clearly, when faced with this pandemic, went big. And in hindsight, it looks like that was a wild overreaction. You don't know that, and I'm willing to give them the grace of uncertainty because you can't know that that's what it is in real time. It's a very different set of decisions to be making those decisions as this is happening versus now in retrospect. That's why I'm saying I think at this point, it's the zeitgeist view. It is generally understood that the lockdowns were overdone. I don't think we'll see that again, by the way. Because I think everybody's learned and everybody wants to keep their job. So in the political sphere, everybody got punished for those lockdowns. Look across the world. UK, Japan, US, one after another, governments got booted for those decisions. Germany, on and on and on it goes. France, he didn't get booted because he's not up for an election, but he's lost all his power.
You know,
So-
go ahead.
Yeah, so I mean, governments made a bad call. They got punished. I don't think that there's anything here to say that the central bank somehow shouldn't have been created in the early 1900s.
That's not what
because banking chaos was better than this.
This is exactly what I
Because
wanted
that's
to
the
say.
context you brought it up.
I think that's totally fair. The last point that I was going to make is we're having this big spirited discussion, but the greatest irony is our positions on the topic are very close together.
Absolutely.
The opposite sides of the spectrum
mostly agree.
You know, there's a group that says and the Fed, just tear it all down. And I know that the consequences of that are so grave that it's a non-starter of a conversation. That's not where my position is. My position is acknowledge, don't tell this one-sided heroic story of a central bank that saved us from bank failures. Acknowledge the negative consequence of the incentive structure it creates and has created. It is, and it doesn't put there are no constraints. When you don't have constraints on power, it can be used and abused.
There's constraints, but again,
there aren't. No, there aren't.
Of course there are, but
what's the constraint?
There are. Well, we just see the constraint in real time over the past 2 months. Yeah, you do something stupid.
If I can do But if I do yield curve control, I can minimize that constraint. It's all funny money, bro.
No, you can't. We just learned.
Yes, I can.
Japan just tried it. No, you can't.
What do you mean?
Well, they failed. They had to take it apart because it almost crashed their bond market.
But how long did it kick the can? They kicked the can for 20, 30 years.
Zero.
Japan they kicked the can for 20 or 30 years.
And even they couldn't
sustain
sustain it. They couldn't. Even Japan, whose interest rates were zero for lack of inflation for 40 years, still couldn't keep a lid on yields. The fact that it fell apart in Japan tells you it is completely unworkable. It cannot be done. The markets do not care.
Agreed.
They
all
will
this stuff
take
is
rates where they want to take them.
All this stuff is unsustainable. But if you get put in a box, you just go, what is my method to extend and pretend for the next 2 years, 4 years, 10 years, 20 years? This is all an extend and pretend.
I don't put that on the
game.
central bank, though. The central bank did what it was supposed to do. The central bank was in a sense, an amplifying factor on the bad decision made fiscally. I don't think that fiscal decision was, by the way, a nefarious decision.
I didn't say it was.
Right.
Bitcoin's going to $1 million.
I think that's a separate conversation.
That's what the viewers need to know. That's what that you distill this conversation down to. Bitcoin's going to $1 million.
By the way, very interestingly, right? So we said we were talking about how these markets are weird and kind of bifurcated, and risk sentiment isn't really being consistent. Take a look at Bitcoin, and it's kind of more so falling in line with what you see in the skeptical part of the asset mix, because it's hanging on to these highs and it doesn't want to break them. So it's not doing what stocks are doing. Stocks look much more optimistic. It's an interesting sort of thing.
Let's do a quick thing. I know we don't usually take a break on this show. We go straight forward, but if you don't mind, I got a toddler in the back I got to go address. So can we take a quick 60-second break, and we'll be right back. I don't know, Paul, if you're in the control room, if you can hear me. Let's take a quick break, and I'll be right back.
Let's do it.
All right. Thanks, Elliot.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision, there wasn't a lot of innovation, and I think that left a door open for us, which we really liked. After almost 20 years of open outcry, standing in the pit trading, I felt like all the markets were moving from kind of traditional open outcry to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. Most of our competitors have legacy technology, and some of them are multiple firms. Their technology has just been rolled up into a single platform. That's not the best way to build a platform. We built ours literally from scratch. It's from the ground up, so we were able to design it in the way that we wanted to design it with the flexibility that we wanted. And obviously beyond that, we do have, in my mind, the greatest customer service in the industry. You want to reach out to me, you want to talk to JJ, it doesn't make a difference who you want to talk to. We're always available, and not only are we available, we look forward to your questions. We're here to support whatever you're looking to do. So you can trade stocks, you can trade options, futures options, crypto. We're agnostic to product. We have the tools that you need to be a successful trader.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
could be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts. Some people say it's insane. That's what I do.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
And we're back. Thank you very much, everybody. Ilya Spivak, that's probably a message from God. We were getting a little spicy there. It was a fun conversation, my friend, but ultimately, what I was saying was I don't think we're that far away.
No, we're not.
I'm not trying to say burn it all down, burn down the institutions, but I think we're at this moment in time where we need to be clear-eyed about the institution. Historically,
yes.
Historically, we're the generation, if you listen to Neil Howe and you follow his way of thinking about the world, our generation comes in and we say, hey, there's problems, and we go, let's not fix these problems, let's burn down all these institutions. And that what happens is we have to go through the problems of previous generations from 80 years ago in order to get back to the point of just moderately fixing the institution. And I hear what you're saying, which
Dalio and Friedman and them have offered similar views, and there's something there. There's something there. That there's a kind of institutional reinvention cycle, and we're there now.
Yes. And I'm not saying burn it down. I'm saying be clear-eyed about both the advantages and disadvantages of some of our institutions, and look for opportunities to strengthen and improve those institutions. And that is a nuanced take versus the let's burn it all down.
100%. And I agree with you. And by the way, the Fed agrees with you, because they're in the middle of this whole framework review. And the latest we just heard from them, Powell just talked about this last week. He was like, this whole average inflation thing we were talking about? Yeah, it turns out that's a dud. And we're going to stop doing that. So, yes, 100% yes. If you came out of COVID and thought what we just did worked well, you are in the minority of opinion. And that includes the Fed. It includes other major global central banks. It certainly includes all of the new politicians running most of the world's major economies, swept into that place because the previous people got booted for their COVID decisions.
And we just move on like it never happened. And that's what's infuriating.
I think hopefully we learned something. And
yeah, hopefully.
Hopefully we learned something. I think where Friedman's argument, very similar to Howe's, very similar to Dalio's, but I think where he does a good job is he really shows you how every time you get one of these institutional transformations, and he goes through a few of them, in particular through the U.S. lens, you're solving a problem, you successfully solve it, but the solution creates a new issue. And then the next transformative cycle is the solving of the issue you just created. But then that creates a new issue. And so over and over and over you go. And you solve the Great Depression with tons of government spending, and ultimately you get out of that funk. And obviously the World War amplifies your capacity for tons of government spending. That creates inflation. Then you fight the inflation. You fight the inflation, that gives you income inequality. You get to income inequality, now you're fighting that. We'll fix this. It'll give us some new issue, which 40 years down the road, we're going to have to unpack.
Yeah. And hence Hence the incentive to just go libertarian. Hence the incentive to just go, you know what? These people don't fix anything. They just shuffle the problems to someplace else. All right. What are you doing with? I'm terrified because whenever I start messing around with currencies, I'm going to get in trouble. And I faded the euro the other week, and now I'm kind of looking for another opportunity to fire against it. I have this worldview, Ilya, that at least for a very short term, I like the long end of the curve. I like the flattener, meaning I like short ends to rise or continue to rise a little bit, just a little bit more. I like that flattener since about 67 basis points. We flattened up to 45. So I've liked the flattener. I've liked the long end of the curve. I like a stronger dollar. And it all kind of goes together. In my view, you've pointed out how that could potentially play out to not necessarily be the case, but in the short term it has. Mm-hmm. What are you doing with the euro here? What are you doing with the British pound? What are you doing with the yen and the Aussie dollar? I need some Ilya Alpha. Call this segment Ilya Alpha.
Here we go. I'm long Aussie. I'm long the pound. Both of them, well, the Aussie didn't even attempt much of a downside break, but it will not go down. It absolutely refuses to go down. In fact, the dollar refuses to rebound more generally. Like you had this unclenching in the bond market. Stocks are obviously ripping off their April panic lows. Dollar hasn't really come back. Mm-mm. And that is probably my highest conviction trade on the board. You look at the market and you go, this is the most liquid market in known existence. Believe it. Nobody can tell currency markets where to go. This is, first of all, tremendously bigger than all of the world's stock markets combined, because this is just cash. And second of all, it exists outside of exchanges in a lot of it. Some of it, of course, futures exist on exchange, but futures are a derivative. The underlying is just spot money moving around the world, fueling economic activity, but of course, not without a speculative sheen. And so you get this giant market telling you the dollar will not come back. I think you got to believe it. And so with the euro, I don't think you have confirmation. You've basically you've started to come back, but you're still sort of on the underside of the range you broke as you corrected lower. So I'm not ready to buy the euro yet. But if you want to look at what this looks like when it starts to be confirmed, have a look at the pound. It has done that. So it tried to break lower, rebounded, and then came back into its range. So I'm long it. The Aussie never really tried to break down. I'm long it. The yen is rallying. I'm long it. The Canadian dollar seems to be trying for a bottom. In fact, when it had really low inflation data today, you really got to give the markets credit. They looked through that, saw that the core inflation reading was rising, saw that it was a one-off inflation downtick because they scrapped their carbon tax and actually took both yields and the Canadian dollar higher. So I am pretty bearish on dollars here. I just don't have the euro piece on yet. I had it on, obviously. I got long in February. I rode that entire move higher. In fact, that's been my best trade so far this year. I'm very much looking to get back on.
What do you think happens with this big, beautiful bill? Do you think Do you think, like, how big of a change do you think they're going to make from the version that got shot down last week?
Probably something cosmetic, because I think the president's power within his own party is, at this point, overwhelming.
How can you only do something cosmetic if the reason it was shot down was because of how much it's adding to the deficit? Don't you need to meaningfully bring that down? You're adding something between $3 and $4 trillion.
Way. It doesn't seem, and I'm not by any means a U.S. federal budget expert, but it does not seem like, just sort of doing the math on the back of an envelope, it doesn't seem like you can achieve what is the president's objective, which is to give everybody all these new tax cuts, like the tips thing, the overtime thing, to lock in the previous tax cuts, to do something on SALT deductions, which all of the expensive local tax Republicans want, those from my home state of California, those from New York and Illinois and so forth. People want bigger SALT deductions, and if they don't get a deal, then the whole thing falls apart and the SALT deductions revert to even greater because the whole thing gets undone. So I think it's very difficult to imagine how you do all those things and not grow the deficit if this is what you want to do. If these are your objectives. So then the question becomes, how do you convince Republicans that are deficit hawks to stop opposing it? And I think the way you do that, maybe, we'll see, but maybe the way you do that is you tell them, listen, nobody is trying to get primaried next go-round. Let's make the right decision here.
Maybe you're right. Maybe because the president
is very popular, and he's used that stick before.
Maybe the cosmetic thing they do is remove the cuts to SNAP in Medicaid. I when I looked at this thing, I listened to the All In podcast the other day, and Friedberg was talking about this bill and why it was so bad. And it was, from his point of view, it was bad because it was adding so much money to the deficit. And what I found fascinating, Ilya, is that the points he chose to focus on, he was basically saying that we needed deeper cuts to SNAP and things of this nature. Nobody is talking about the defense part of the budget. Defense makes up 13% of the federal budget. SNAP, a program to feed hungry kids, makes up it's less than 2% of the overall federal budget. And to be talking about
any more correct. I fervently agree with this.
Bro, to be having this conversation like, it does, to be pretending
and Medicaid,
like that is
for the
problem.
Poor,
it's
healthcare for the poor and food for children is what we're talking about cutting.
Especially by 4 billionaires on a podcast are looking at this thing going, oh, this adds too much to the deficit. Okay, I'm with you. We do have a fiscal problem. But then to be going, we need deeper cuts into SNAP? What are you out of your mind?
This is where I get the spiciest I get on these issues. Because it drives me absolutely insane. You have the benefit of time to sort out your budget, unlike any other country in human existence, because you've baked the dollar into the global financial system and made it indispensable. You've baked the treasury bond into the global financial system and made it indispensable at the extreme cost of blood and treasure after World War II. You put together this system where you've made yourself an imperfect and capricious but an ultimately effective referee. There's not been a crazy war since. Nobody decided to shoot nukes at each other. There's been an incredible surge in global prosperity. Millions of poor people have been taken out of poverty thanks to globalization. And it's imperfect, and it's got warts and terrible side effects in places depending on who you are. But on the whole, you've bought yourself all kinds of time to look at this system and say, nobody's breathing down my neck about this deficit because I've made for myself this beautiful moat of treasuries and the dollar that everybody's too bought into to get off. I have time. And instead of using that time to productively change your fiscal trajectory and to productively change the negative impacts of globalization on your industrial sector, what you're doing is you're filling the moat and letting the bad things come and wreck you. It makes so little sense that it is just absolutely mind-blowing.
This thing makes literally nobody happy. And I can't see them, if they don't make massive changes to this thing in order to pass it. Dude, it's not going to, they're going to lose a significant portion. It'll end in more deficits. I'm talking politically. Politically, it's not smart. You don't appease the fiscal conservative. You don't appease the lower end of your base. That is going to get, and technically they say, we're going to cut 5% of the actual benefits, and most of that cut is going to come from 75% of administrative costs. But it's just like, you're not going to make, politically, it's going to be a disaster for them.
Well, and this is why Doge ultimately didn't achieve anything, right? Because Doge could only do the very limited things, and they did more than they were allowed. Obviously, this is why we're getting people rehired back, and a lot of these firings getting undone and canceled. And now those people have to be rehired as contractors, and so actually they cost more, not less. Just
that's not happening at scale, man. That's an article you read.
But this is the thing. Of course, it's not happening at scale, because Doge could never tackle the parts of the budget where there's scale.
Correct. And that's a good thing.
And this is the whole thing.
That's a good thing, by the way.
Well, yes, but this is the whole thing. This is why Doge was basically a blue ribbon committee, but sold as something that's a real quest for government efficiency. You need Congress to do
they
this.
Were just they never even went to the Pentagon. My biggest thing with them is there was like the amount of press coverage that they generated to get $160 billion worth of cuts. And like $160 billion is not nothing. So I will say that. It is something. And $160 billion we shouldn't be spending is something. But my thought of Doge was, not only was it going to eliminate just outright stupid uses of money, but I kind of thought this is going to be a world where I walk into the DMV and I don't spend 3 hours, and we have a more efficient government that works better for the people, and then I'm walking out, I'm in and out from now on in 5 to 15 minutes.
That would be, if that was it, that would be good.
This was my, like, that's how you save money, right? If things take less time, you can do more with less. That's how you save money.
Sure.
But what ended up happening is we just fired single moms from the government.
Right.
And a couple of things we were using money in a very strange way.
Yes.
But nowhere near the scale that they were trying to address. And what happens is, so you get stuck. You promise $1 trillion worth of cuts, $1 trillion worth of additional revenue from Howard Lutnick, from effectively tariffs and new trade, and that's going to pay for whatever this thing is. Unfortunately, the new money that's coming in is nowhere near what the expectation is, and the cuts were nowhere near what the expectation is, and that's how you end up with this big stupid bill that's going to cost us between $3 and $4 trillion. And they're not pivoting. They're like, these things that we thought were going to work and bring us $1 trillion on this side of the balance sheet, $1 trillion on this side of the balance sheet, they didn't work. We should pivot what we're asking for, but they're not. They're asking for the same amount of shit without the money to pay or the cuts to pay for it. And that's how we're in this position. And nobody's saying
said 100%.
They had a strategy. It didn't work. They didn't pivot. And nobody's saying anything right now. It's crazy. And that's how you get bonds at like 111, 112.
I agree 100% with everything you've just said. Some of us here have said that this strategy is not going to work because it's too crude, that the president is tremendously good at identifying what the problem is.
See, what you're doing right now is hindsight bias. There's no way.
No, it's not.
Yes, it is. There was no way that. Was I not
skeptical about all of this?
There's a difference between skepticism and then saying, I told you so. Here's the difference. Because you didn't know what Doge was going to find when this started. If you were smart, you knew they weren't going to find $2 trillion in cuts.
Right.
You also knew that $1 trillion was a BHAG. It was a big, hairy-ass goal that was likely going to be on the top side of expectations. On this show, we had them between $300 billion and $800 billion of possible cuts. That was in my mind, I thought that was the range. 160 is so light. What you also didn't know, you didn't really know how that tariff negotiation was going to, is this all for negotiation? Are they really going to go through with this? Where is the actual tariff line going to land? Which meant you never knew what the revenue side was going to be. Then on the flip side, you never knew, based on the cuts, based on the revenue, whether they would adjust their asks. You didn't know any of this stuff. You were generally skeptical.
That I think you still don't know.
What you're doing is hindsight bias.
I don't think so. And here's why. I think that's a fair critique. I will retort. I never said that it mattered why the tariffs were there, and have maintained that they're stupid. That they were stupid when George W. Bush did them. Then they were stupid when Trump did them the first time. They were gonna be stupid again.
Were they stupid when Biden left them on?
Yes. Of course they were.
You think he should have removed them?
I think tariffs are stupid. I think using tariffs in the way that both sides have done it, not that rebalancing trade is stupid, not that we don't have relationships that we need to renegotiate and change, not that China hasn't been a bad actor. Again, the problems are being identified correctly. But the method to go about them, that tariffs raise revenue in a growth positive way, that's stupid.
Agreed.
Period. No matter who does it.
Agreed.
So
I don't think that's why they're being used, but go ahead.
Whatever it is that you are doing, that this is the course of action you are taking, it's a stupid course of action, in my opinion. And that's regardless. I understand why Biden didn't take down the tariffs that were there, because once you are in a position where if you do, the other side has leverage, and so you kind of boxed in. I get that. Every administration is to some extent, every administration is to some extent boxed in by the previous administration. That's normal. That he increased the tariffs? Stupid. So I've said that from the beginning. I think, and again, not that they're addressing issues that don't need addressing. These are separate conversations. They do need addressing, but that's not the way. Then the idea that you were, let's put it this way. I knew Doge was a bunch of nonsense when it became clear that this was not going to be a real government department with real congressional power to do stuff. Because then a ton of the spending, the lion's share of spending, becomes untouchable. Because you need Congress. Otherwise, you're just tinkering at the margins doing nothing. And that this was not going to make a big dent. So that was clear, I thought. When they didn't give them real power, congressional power, to go after big things, entitlements and defense,
They gave them the limits that they could give them without getting tied up in court, man.
That's right.
What you just said, one of the most interesting things you just said was the incentive structure of the next administration not to remove tariffs. And I was thinking about this last night. I was like, this is year one of a 4-year presidency. Yeah. And I go, what if you leave tariffs on for like 3 years?
Nightmare.
No. Listen, if you leave them on for 3 years, is the next can the next president come in? Like, that's a long enough time for it to get like built into the economy. Can the next president really come in? Would it be politically popular to come in and remove them? And now all of a sudden you've got Chinese EVs being sold for $10,000, and you've, GM and Ford are firing 150,000 union workers. Part of me goes, if you leave this on for 3 years, what happens? Is it ever going to be politically popular to remove them? And I don't know that the answer is yes.
I don't think that I think if you look at it in isolation like this, you can have an interesting calculus. And politicians, to your credit, I think you framed the question perfectly. Politicians are two-dimensional in their thinking. Mm-hmm. It's why we have globalization without any regard for what Adam Smith would have told you would be the cost. And you did nothing. Bipartisan, nothing. Right? You had a great string of presidents that understood that globalization, by the way, for our own self-interested reasons, we had an inflation issue, and it became necessary to organize ourselves to the lowest possible common denominator on cost to bring that inflation down. And that meant monetary measures, that meant corporate restructuring to prioritize shareholder value, that meant opening global markets to reduce prices. It worked. We had 40 years of declining inflation and declining interest rates. Globalization worked. It solved our issue. It just created others. But Adam Smith would have told you that's what would happen. That things aren't costless, and this is what happens. That we did nothing across Republican or Democrat administrations to address those things just tells you the political side of this story isn't the economist side. It's two-dimensional. It's what you can sell. Mm-hmm. And it's what you can sell that the other side isn't putting on their menu. Because what you want to do is create differentiation, and then you want to sell that. So, yeah, if you look at it in isolation, somebody could be that dumb as to say, you know what the easiest thing to do is here? The economy is creaking under the weight of a tariff that's 5 times greater than it was 3-5 years ago. You know what the easiest sort of point here is? The easiest button to push? Let's just bring them down and open it back up. Woo-ha, economic boom. But the reason you can't take it in isolation is because China isn't China. China today is not China 5 years ago or 10 years ago. Their average age is past the peak age of consumption. Some estimates are saying that the average age that there are more 53-year-olds now in China, that like 53 and up than 53 and below. And peak consumption for humans averages around 48. And then you wonder why for 2 years they've been priming them with all this money and they won't consume. So they have a terrible demographic issue. They can't get that economy growing to save their life. Everybody has raised barriers against their dumping of their cheap stuff that their own consumers can't absorb, because their entire method for growth for a decade plus now has been create funny money out of nowhere. No, that's not the same as us because they're...
Sound familiar?
No, because they have capital controls. Mm-hmm. We don't. We actually are able to borrow our money in the open market because we've created this exorbitant privilege architecture for ourselves. We're different. They just closed up the borders to capital, created an artifice of prosperity. And again, from their perspective, it makes sense because historically, how does the emperor keep the Middle Kingdom whole? Everybody has to have a job. Everybody's got to be fed. We've seen the Middle Kingdom come apart a gazillion times in history because the emperor couldn't. That's how in China dynasties fail and new dynasties emerge, and there's periods where the whole thing breaks apart into constituent, independent polities. We might be going there again.
I think the thing that works against their plan, the current administration's plan, is the question that you and I are discussing right now. Because what you need people in order to invest in a company in a labor cost long term. You need to have confidence that you understand, even if the tariffs are there, you just need to know are they going to stay?
Yes.
Because if you make the investment to build something here in the United States, and then the next president, assuming the pendulum swings back the other way, removes that protection that you built your business model under.
Yes.
You're screwed. So
that's what I've been saying all along.
Sure. But it's like most people focus on the on again, off again of the tariff itself, or what's the rate. And what I'm saying is it's bigger, more broad.
I agree with you.
If I don't think they're going to last for 4 years, why would I do anything at all? I'm just going to pay you lip service.
Order makes it that level of weak in terms of shaping expectations. This is what I've been saying all along, right? That the problem with the tariffs would have been a problem in November were it a problem with the concept of tariffs. It's not. The problem is with the way that they're being deployed and the absence of forecastability in what they want to achieve, which is reshoring manufacturing and all of these things. Never mind, by the way, that we shouldn't be, at least. I don't know if we are. That's a question for the administration, but we shouldn't be trying to reshore the manufacturing of Nike shoes. That's not the kind of manufacturing that we should be trying to foster. We should be trying to foster high-end manufacturing, like the processing of rare earths, say.
Yeah, agree.
But that's a separate conversation.
What's that Chappelle joke? What's that Chappelle joke? Most Americans want to make or wear Nikes, not make them.
Right.
All right, man. This has been fun, spirited discussion. We almost talked about nothing on the. We started with it. Somebody said, "What's the best way to trade all this?" From my point of view and opinion, a lot of the best way to trade what we're talking about. I hate to say it, but like you could see this coming back in 2022. You could see that either Powell's got to crash this thing and bring us to the left tail, or they're going to do what they always do, and we're going right tail. And if we're going right tail, you buy physical metals at that point. And if you still think we are clearly headed towards a world where we're not going to, even the fiscal conservative group is putting out budgets that are adding $4 trillion to deficit, then what that means to me, very simply, is Bitcoin's probably got a little ways to run and silver probably needs to play a little catch up. So we had this whole discussion, and I'll make it actionable from my point of view, which is Bitcoin and silver are probably the most interesting plays on the board to me, given the fact that these people clearly are not going to exercise fiscal discipline. Ilya, I'll give you the last word, and then we'll wrap up.
I don't think they're going to exercise fiscal discipline. I think you're right there. I just think it resolves a little bit differently. I think it resolves in the tariffs and all the other things making for a defensive consumer, and which we're already seeing, and a recession. That recession will get the Fed to cut rates. Those rate cuts will make shorter term fiscal nonsense a little bit more digestible, though it won't solve any of the issue whatsoever. And that what this will resolve in is higher gold, higher bonds, weaker dollar, weaker stocks.
Imagine this world, Ilya. Imagine a world where we do creep into recession, okay? And the Fed is not budging because it's not deep enough for them to do an emergency response.
Kind of getting there.
Now imagine this part, okay? So now imagine, because the administration is not getting what they want out of the Federal Reserve, they themselves have to come up with some sort of quote unquote rescue package or fiscal package. Is this it? You know, that would be like
fiscal expansionism.
But that would be maybe. But this sort of is the stamp on the roles reversing on the political parties.
Yeah,
you get what I'm saying?
This is Bizarro 08.
It is. There is no party that actually there is no fiscal conservative.
No.
There is no balanced budget. There's just spend $4 trillion or blow out the budgets by 7.
Well, and
that's
everybody
where we
keeps
are
saying
right
stupid things like we got to grow out of it.
We'll grow our way out. That's the dumbest.
And it's like, yeah,
people
okay,
keep
but
getting sold on this.
Yeah, but you're not going to grow your way out of it if you keep doing things to hurt growth, are you?
All right, man. It was fun, Ilya. I think it was spicy at times, but we agreed more than we disagreed this episode, which is infrequent. I thoroughly enjoyed this conversation, Ilya, as I usually do. This time I'm going to wrap up early so I can address my 3-year-old baby girl I hear out there. Do me a favor, Ilya, if the people want more from you, and they certainly should, tell them where they can go.
As always, I'm all over the PM schedule on tastylive.com, Overtime, Macro Money, this show. I'm writing for the news and insights portion of tastylive.com. I'm commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky because all sides of the political divide need this macro.
Right on, my friend. If you want to find me on Twitter at Victor Jones, the Owen Jones is 0 because I like to be difficult. I'll see you back here tomorrow for a conversation with Chris Vecchio. Same time, same place, same great network, only on Tasty Live. Till then, peace.
Peace.